any kind of whiff of positive news around trade talks that could propel us a bit higher.
Just starting these conversations is going to be the number one priority.
You need these trade deals done pretty quickly, because if not, the uncertainty shock hits the economy.
Starting the dialogue is the most important thing.
People need to start focusing on is where are we going to end up? What is that effective tariff rate that we're going to settle at?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday with a major de-escalation.
We have an agreement on a 90-day pause. Both sides on the reciprocal tariffs will move their tariffs down 115%. Neither side wants a decoupling. And what had occurred with these very high tariffs, the equivalent of an embargo, and neither side wants that.
The US and China ending an effective trade embargo, striking a 90-day agreement to slash levies on each other. The truce surpassing investor expectations, sending equities higher worldwide and fueling a bounce in the US dollar. We're kicking off a brand new trading week with a surprise agreement.
And here's the question. How much more does this signal about how the process is going to continue? This is a significant and much bigger than expected dialing back of tariffs. What have we learned? Number one, Scott Bessent seems to be in charge, which seems to be a good thing for markets. Second of all, that 90-day time frame might just be a start in terms of the delays, given the fact that Scott Bessent said that things could continue beyond that as long as talks are constructive, John.
So the good news, Bramo, here is that the worst of the trade talks might be behind us. The worst of the tension might be behind us. The worst of the data might still be in front of us, and trying to process what the data looks like in the coming weeks and months is still going to be tremendously difficult.
It is going to be incredibly messy, given the fact that there's a whole pull forward type of mechanism here, and that it takes a long time for some of this data to show up. Let's take CPI, for example, which we're going to get tomorrow. The last time around, it took 2 months for the washing machine increase in terms of pricing to hit CPI data. Will it be faster this time, given the scope of potential items affected, and how much can people look through the mess of the pull forward demand and some of the other disruptions that we're seeing in the short term in markets?
CPI on Tuesday, then on to retail sales on Thursday. Chairman Powell on Thursday. Also on Thursday, earnings from Walmart. These retailers that have had to position their inventory going into this mess, all of a sudden you get a double dose of front loading. All of a sudden, everyone's going out there scrambling to secure imports from China.
So this is going to be, I think, the event of the week, potentially. How Walmart is dealing with this, as well as how they're potentially passing along those price increases or not to their consumers. Remember, Walmart came out and said they want to compete on price. They don't want to compete necessarily when it comes to anything else, which means they are going to absorb it in their margins. And maybe we'll get a better sense of just whether it's margin absorption or passing along that we get from a corporate response to some of these tariffs.
Equities bouncing hard so far this morning. Good morning to you all. Up on the S&P, on the NASDAQ, on the Russell, big time. Coming up this hour, we'll catch up with Russ Koesterich of BlackRock. As US-China trade tensions cool off, we'll catch up with the former Trump White House trade official Kate Kalutkiewicz. And we'll catch up with Torsten Slok of Apollo ahead of key inflation data. We begin this hour with stocks rising as the US and China agree to lower tariffs for 90 days. Bloomberg's Tyler Kendall joins us from Washington for more. Good morning, Tyler Kendall. What a weekend and what a result this Monday morning.
Yeah. Hey, John. Good morning. Well, a major reduction in tariffs designed to give both sides time here to reduce those trade tensions. The pause will go into effect by this Wednesday, May 14th. And to reiterate, the U.S. is set to lower tariffs down to 30%. That appears to be that 10% baseline so-called reciprocal tariff stacked on top of a 20% tariff that's been in place over fentanyl concerns, while China is set to lower its rates down to 10%. And both sides really seem to tout the fact that they had created this mechanism to further talks and prevent other escalation, which really just reminds us that at the end of the day, they need to further these talks, and trade talks do take time. Now, the USTR Jamison Greer appeared to suggest that differences between the U.S. and China weren't as large as previously thought, but we do know that those differences are pretty wide-ranging. He said that he felt that progress could be made on fentanyl, and the Treasury Secretary Scott Bessent said that purchase agreements will likely be part of any finalized deal. Plus, we had China release a statement saying that they are set to to reduce or suspend any non-tariff countermeasures, likely referring to some additional export curbs that they've put on critical minerals since April 2nd. But, John, those are just a few examples of those differences that do need to be addressed. And when the Treasury Secretary was asked directly by Bloomberg News, what will it take to prevent the tariffs from going up after these 90 days, he said, as long as there's good dialogue, they'll continue to move forward.
Tyler, that's a pretty low bar. We'll catch up with you a few times this morning, but just a quick question from me. What would it take to get a meeting at the leadership level? Was that discussed over the weekend?
Well, President Trump said that depending on what Treasury Secretary Scott Bessent advises him to do, he would be willing to hold a call with Xi Jinping. We know that he has previously extended that invitation. That used to be what that watermark was in order to jumpstart these talks, that the White House wanted to hear directly from Xi Jinping himself. Call up President Trump like we've seen other leaders do in the past. At this point, it really does remain to be seen. The joint statement, a rare joint statement, in fact, that we got from the U.S. and China really seemed to make clear that it's Treasury Secretary Scott Bessent who's leading the U.S.'s path forward here.
Tyler Kendall with the latest. Here's the latest in big tech. If you check out the pre-market, a few big movers, the likes of Apple, Amazon, Nvidia. I want to pick up on Apple. Apple right now, report from the Wall Street Journal. Apple mulling raising iPhone prices without blaming tariffs. Now, Bram, I wonder what happens here, because there's no direct assertion here that this is about tariffs, but ultimately people might read between the lines and say this is probably about tariffs.
You think? Maybe? I mean, this basically is what a lot of people have been expecting, that as soon as there is some sort of realization of the lack of shipments coming here, that Apple in particular is going to be singularly identified and subject to having to increase their prices. This is going to be tricky. How much does Donald Trump use this as an example to jawbone them down, given the fact that in the past he has said the American people are not going to see these prices increase, and this was the running platform for him heading into this election. So this is going to be a real test on both sides.
Apple higher in the pre-market by 7%. One of the stocks to watch this morning, one of many. Here's the view on Wall Street so far. Russ Koesterich of BlackRock writing the following: the stabilization in equities and other risky assets makes sense based on A, some progress in trade negotiations, and B, generally supportive economic data and earnings. Russ Koesterich of BlackRock joins us now for more. Russ, we've got this odd tug of war, this short-term reaction to the progress we're making in trade talks, real progress between the US and China, and then long-term, just realizing the tariffs are higher now than they were at the start of the year, and that could be disruptive for growth in the future. How do you weight one versus the other?
Well, good morning, Jonathan. You know, it's funny, whatever you write 2-3 days ago probably is stale, given the pace at which headlines are coming out. But I think you're right. I think we are in a tug of war. Obviously, this morning we got some very good news. It reduces the risk that we're going to see a serious economic contraction. It reduces some of the uncertainty. It reduces some of that left tail. Having said that, we still have to contend with a few things. One of which is there's still uncertainty. The second of which is how much did the previous disruption hurt economic activity, whether it was at the consumer level or at the corporate level. And third, and again, valuations are not the best short-term timing tool, dealing with the fact that even with the pullback we had earlier in the year, S&P's back to trading at 21 times future earnings. That's a big number given all the other things going on. So I do think it's a tug of war. I think we're still in a range, although that range is probably higher on the upside and lower on the downside than it was on Friday.
Did we learn anything, Russ, that makes you materially change your allocation given some of the uncertainty that remains out there?
I don't think we would change our allocation. I think a lot of the themes we were thinking about on Friday are still in place. You know, one of the things that we were looking at that I do think is going to probably work in the back half of the year, we had that big rotation earlier in 2025. Everyone piled into defensive parts of the market, whether it were staples, utilities. I don't think that was right. And that really made sense only if you expected a recession. To the extent the odds of that are lower, we're probably going to muddle along with the economy. I do think some of the large mega cap tech names that struggled earlier in the year can actually do well in an environment in which growth is okay, rates are contained. And many of these big themes that we were all talking about back in 2024, they're still very much in place. So that's one area of the market I do think is a place to be in the back half of the year.
It looks like a lot of people agree with you, Russ, because it looks like we're entering something of a bull market in big tech, possibly up 20% from the trough on April 8th. So you can see this kind of knee-jerk reaction. When you take a look at what's changed, what's not back to that pre-April 2nd relationship of markets, it's the dollar. the dollar is still not completely back to where it was. And it raises a question, has anything materially changed since Liberation Day, given the fact that we are seeing a walking back of a lot of those tariffs? How much is the dollar fundamentally and structurally in a different place today than April 2nd, even with some of the ratcheting back of tensions?
Well, I think there's definitely more uncertainty. And you've got to ask the question, are we going to see some diversification out of dollar-based assets from international investors? And I think that's still very much an open question, given the fact that trade is going to look different going forward than it did, 2, 3, 5, 10 years ago. Having said that, it's interesting. There's been a lot of agonizing about the dollar, and I think that's right. But having said that, the dollar has basically been in a range mostly between about 100 and 110 in the DXY. It was down at the lows around 11, 12%. We had seen similar pullbacks in the last 5 years, even without these generational or potentially generational shifts in trade. So I think the outcome on the dollar is still very much a question mark. And we may not know that for a period of time as we start to see how international investors really are behaving.
Russ, in some ways, it's part of the same question. How to manage your exposure to US Treasuries. What have you and the team done? Has anything changed for you guys over the past few weeks? And would it flip back based on the discussions we heard over the weekend?
So, Jonathan, it's really interesting. Our duration position has not changed much this year, despite all of the volatility. We've been slightly underweight our benchmark in duration. Most of that is on the long end of the curve. As we've spoken about in the past, we do like credit. And I think that's still probably about right. We've seen that back up in yields this morning. So I think, as of now, that positioning seems to be about where we want to be. But it's worth keeping in mind, even before we started talking about the dollar and we started talking about whether or not international investors would abandon the dollar, there were those concerns about supply, the concern about the deficit, about whether or not that was going to have some negative impact on the long end of the curve through the term premium. Those concerns are still there. So I do think while we are closer to benchmark, a little bit of an underweight on the long end probably still makes sense.
Those concerns, Russ, as you know, are pretty durable. They're not going anywhere. The big question was whether international investors would be willing to finance that deficit or whether we would need one or the other or a combination of the two, which is a weaker dollar or higher bond yields. Do you think we've settled some of those issues or do they remain as well?
No, I think they remain. I think it's certainly too early to declare all clear. And I think a little bit of caution, particularly given the fact that we do have those structural deficits. You're exactly right. And the term premium is not so high that you're being generously compensated to go out on the curve and take that risk. The other point is, do you really need to? Rick Reeder has spoken about this on many occasions. If you have an environment where credit spreads are maybe not great, but the absolute yield you can generate on a high-quality credit portfolio is 6 or 7%, do you really need to take a risk going out to 10-year on the U.S. Treasury? Maybe not.
Hey, Russ, appreciate your time. As always, it's going to be another busy week. Russ Koesterich there of BlackRock. Russ, thank you. I want to go back to big tech. Check out Apple, Amazon, and Nvidia in the pre-market, and let's sit on Apple. A story dropping just moments ago. Apple up in the pre-market by 5, 6, 7% now in early trading. This from the Journal just moments ago, if you're just joining us. Apple considering raising iPhone prices.
When you take a look at the details of the story, one thing that stands out is Apple found what Walmart found, which is they cannot just make up for any increase in tariffs by job-owning suppliers to lower their prices. They have to either take a margin hit or they have to raise prices. They're opting to raise prices to preserve margins. If they don't raise prices, their margins will take a hit. There is a bigger question here. Let's say 30% is the new normal. How much does that also impede the profitability of some of these companies that highly rely on China for both manufacturing as well as for sales?
The new normal seems to change from week to week at the moment. The new normal apparently is 30% after it was 145% just a few days ago.
So if this is the new normal for 90 days and then maybe another 90 days, how much of a hit is that? That's manageable. It's not a trade embargo. But at the same time, how do you price that in? And does it warrant the same levels that you saw before April 2nd? And that, I think, is going to be an increasingly big discussion.
Apple up in the pre-market by 6.8%. Futures this morning on the S&P higher by 2.9%. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Anand. Hey, Yahara.
Hi, John. Starting with the major story of the day, the U.S. and China have agreed to temporarily lower tariffs on each other's products for the next 90 days. The U.S. reducing its levies from 145% to 30%, and China dropping its duties from 125% to 10%. Treasury Secretary Scott Bessent saying, quote, neither side wants to decouple. Meanwhile, Ukraine's Volodymyr Zelensky is set to meet with Russia's Vladimir Putin in Istanbul on May 15th for direct negotiations. The meeting is conditional on Russia beginning a 30-day ceasefire today, with European allies threatening to increase sanctions if Putin refuses. And the Trump administration is likely to accept a luxury Boeing 747-8 jumbo jet from Qatar's royal family to be used as Air Force One. ABC News is reporting the gift is expected to be announced this week when Trump visits Qatar. The president appeared to confirm the gift, calling it a very public and transparent transaction. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, a major de-escalation.
We have reached an agreement on a 90-day pause. Neither side wants a decoupling.
The Treasury Secretary saying all the right things earlier on this morning in Geneva, Switzerland. Equity futures up by 2.8%. Up next, the former Trump White House trade official Kate Kalutkiewicz. Live from New York City this morning. Good morning. A 90-day truce between the US and China unleashing a major rally worldwide. Equity futures on the S&P up nicely. These movers in the pre-market, the ones to watch. Apple, Amazon, Nvidia, big tech is rallying and rallying big time. Apple up by 6.8%, Amazon up by 8 percentage points, and the outperformance this morning on the Nasdaq 100. Check out the S&P, the Nasdaq 100 and the Russell. On the Nasdaq 100 up by 3.8%, and the additional outperformance coming from the Russell up by 4.6%. Go over to the bond market, 2-year, 10-year, 30-year, unlocking higher yields across the curve, particularly at the front end of the curve, as once again we reassess rate cut bets from the Federal Reserve. The 2-year up 10 basis points to 399.56, and off the back of those moves, this move in foreign exchange, potentially the worst day for the euro, going all the way back to the day after the election. Euro dollar positive here by around about, or rather negative on euro dollar by 1.4%, at least at a 110.96 on euro dollar this morning.
It is fascinating to see how much of a whipsaw this is. There is a just market structure aspect to this, how many people had piled into the sort of long euro trade. But when you take a step back, this reassesses kind of the whole narrative that we've seen so far, where suddenly the U.S. is decoupling from the rest of the world. The U.S. is going to get hit hardest. How much does this have legs, though? Because the dollar is not yet back to where we were before April 2nd.
How sustainable is all of this? My head is absolutely spinning, and I'm sure yours is too. Under surveillance this morning, a major de-escalation.
We have reached an agreement on a 90-day pause, substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%. Neither side wants a decoupling.
So here's the latest this morning. The US and China are agreeing to a 90-day cooling off period. The US reducing its levies on Chinese imports from 145% to 30%, while China cuts duties on US goods from 125% to 10%. Joining us now is the former Trump White House trade official, Kate Kalutkiewicz. Kate, welcome back to the program. It was a surprise, not the direction of travel, but the number we landed on. And there was something that stuck out for me over the weekend, hearing from USTR rep Jamieson Greer. Greer turned around and said, when we walked into the room, the differences weren't as great as we thought they would be. How big do you think the differences actually are between these two sides?
Well, you know, it's hard to unpack what we're dealing with here. On one hand, you have this enormous escalation in tariffs. So I think both sides probably walked into that room with the same goal in mind, which was to find some way to provide an off-ramp for those tariffs. So I am not surprised to hear that both sides entered the room with some significant goals in mind, and that was to bring the tariffs down.
And the tariffs are down, and now we have a 90-day pause. And we're all trying to work out, Kate, what happens after 90 days, because you know what happened last time around. You were living it. This took 18 months. Can this be resolved in 90 days?
Well, remember last time during the first Trump administration, we had months and months of a domestic investigation, which led to a number of demands from the U.S. side around forced technology transfer, this intellectual property theft that was going on, openings in key services and goods export markets. Here, we've just had the tariffs go up and up and up with very few clues as to what the Trump administration is seeking to address here, besides what they call balanced trade. So for me, it's still an open question as to what we're hoping to achieve here.
How much does it really surprise you, Kate, that we saw heading into the weekend, President Trump put out on Truth Social, that 80% seemed about right, but it's up to Scott B. Scott B comes out and says 30% sounds better, and that's what we're going to stick with. How much reliance can we put into the 30% number if it's not coming from the president? And what do you make of this sort of mismatch?
Well, on one hand, it shows that the president has tremendous trust in Secretary Bessent, which I think is a great signal. It's a great signal for him as he walks into these talks. And so I see that as an optimistic sign. I feel pretty comfortable that we're at this 30% for at least 90 days. Secretary Bessent has been pushing for additional time on this and the other trade negotiations that he's leading. So I feel fairly confident that this is the number that we're going to be at for a while.
How much is this the roadmap ahead for others that have to get some sort of deal done? And I'm talking about Japan. I'm talking about the European Union. I'm talking about nations that traditionally have been allies of the United States that seem to be having a harder time even coming to the table to ratchet down some of the tensions as they are currently.
Well, even amongst this backdrop, it's hard to remember. Less than a week ago, the president announced a trade deal with the United Kingdom, which was quite important in the signals that it sent to these other countries. I would argue the UK deal perhaps means more to countries like Japan and Korea and others that are seemingly close. The China deal, though, of course, puts other countries on notice that the president is serious about deals. He's serious about moving forward. And so I think this may incentivize other nations to quickly get their deals in hand.
Kate, I can't decide whether this is good news or bad news for Europe specifically. What do you think it means for the EU?
Well, the last time we spoke about how difficult transatlantic relations are, and I think they continue to be very difficult. The European Union, as one of the true believers in the multilateral trading system, does not like this notion of balanced trade, which is what language came out of Switzerland this weekend. They're really going to continue, I think, to struggle with how they negotiate with the United States, what this, significantly less pressure on the U.S.-China relationship means for them globally. And so I think they're going to have to meet in Brussels and figure out their next steps after this last trip to Washington.
Okay, it looks like the direction of travel between the US and China is to revisit the purchase agreements that we struck all those years ago. Can the Europeans actually do the same thing in practice?
Well, there are some purchases I think Europe is looking to make, particularly in the military sector, that would represent a significant go in the direction of where President Trump would like to be, and also satisfy some of the European Union's goals as well. But I don't think purchases alone are going to satisfy the president when it comes to the transatlantic relationship. There are years and years of non-tariff barriers, these regulatory challenges that have posed significant problems for U.S. companies. And I think the president wants to see some wins there.
Okay, appreciate it as always. What a weekend, what a morning. The former Trump White House trade official, Kate Kalutkiewicz there. Got two options here, Lisa. Here's option one. This sets the tone for deals. It's good news for the Europeans. Option two, they need to make an example of somebody and go hard on somebody, because right now they haven't really got hard on anybody. Well,
that's exactly what I was thinking about this morning. Who are the allies and who are the non-allies, and exactly how different is it who you debate with and who you sort of take a harder line with? Right now, the fact that we're talking about VAT taxes as the ultimate barrier, the non-tariff barrier between the United States and Europe, shows how thorny this is going to be to resolve. Do you really think that each independent district is going to remove or change their VAT taxes, which is a major revenue source and is legislated, in order to appease Trump? Can they even do that logistically?
I think it's fair to say the Europeans are at the front of the line based on what we've seen over the past few days.
That's a direct answer.
That's at least one takeaway. Up next on the programme, we'll be catching up with Hugh Van Steenis of Oliver Wyman on the potential end of US hyper-exceptionalism. Live from New York City this morning, you're watching Bloomberg TV. What a start to the week. Tariffs were 145 on China, now just 30%, just 30%, nothing. Equity futures on the S&P 500 positive by 3% on the S&P 500. On the Nasdaq up by 3.9. On the Russell up by 4.5. With 3 hours until the opening bell. Many movers out there with your morning movers. Here's Danny Berger. Hey, Danny.
There's a lot, John, and you'll be hard-pressed to find something that isn't moving to the upside, but it is the Mag 7 that is outperforming this morning. Apple among them, those shares up 6.8% this morning. Dan Ives calling it the best case scenario for the tech bulls, but another story to contend with this morning, the Journal reporting that Apple intends or is at least contemplating raising their prices, but not tying it to tariffs, or at least trying not to make it look like that, tying it to various feature launches. Also moving to the upside, a lot of consumer names. I've chose Nike to put up here, up nearly 7%, but you could look at Lulu, Target, all of them putting in similar work this morning with supply chains exposed. How much relief does this bring them? Ryan Peterson of Flexport saying, expect a shipping boom over the next 90 days. How much are these companies going to move to try to get inventory in for what comes after 90 days? Now, I said you'd be hard pressed to find something that's moving to the downside. Well, there is one sector that is clearly doing that, and it is pharma. Trump over the weekend on Truth Social saying that he would look at trying to lower drug pricing, signing an executive order. We're expecting that this morning, lowering them between 30 and 80% by matching nations that have the lowest prices. Questions as to how that would work, but for the moment, you can see the reaction. Some of these pharma companies down as much as 3.6%, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. On our radar this morning, our top story, the US and China striking a 90-day agreement to slash tariffs on one another. The US cutting levies to 30% and China reducing its duties to 10 following talks in Switzerland over the weekend.
So what have we learned? Because it's been kind of whack-a-mole, right? And this is a huge shift in the potential levies on China and on the United States. We still don't know what the ultimate goal is. However, what we have learned, first of all, is that what Donald Trump says sometimes can be taken literally, sometimes can be taken seriously, and that 80% level was something to be taken seriously, but maybe not literally. The fact that there can be a 90-day delay that is potentially extendable, only with simply good faith talks ongoing, highlights what could be the road of travel for the other potential major trading partners with the U.S.
I think we learned something quite simple. Both saw this as unsustainable. They'd already said that. What was surprising was the extent to which they saw it as unsustainable and brought tariffs down as much as they have done. Point one. Point two would be, I think this is where things get interesting. What is the actual ask? What do we want from either side? What does either side want from us? Because at the moment, I don't think those asks were really made over the weekend. This is about getting them down, getting to a place where the Chinese want it to be, where you can get to the leadership level of talks further down the road. And I don't think we're anywhere near that just yet.
To your point, the fentanyl tariff's still on. To your point, not a lot of clarity when it comes to some of the chip reductions and potential barriers to export chips to China. Not a lot of discussion about some of the other potential grievances. Nonetheless, they are negotiating, and a lot of people are saying that alone is a great thing, just putting aside the fact that 30% is quite considerably higher than it was, say, 2 months ago.
Yeah, the bar was low going into the weekend, let's put it that way. The hard work starts now, not just for China, but for others too, including Japan. Japan's Prime Minister saying the country will not accept a US trade agreement that excludes autos. This is trade negotiations between the two countries are set to accelerate later this month. Japan's chief negotiator saying he's hoping for an agreement in June.
Yeah, saying that they're not going to sacrifice their agriculture industry for the auto industry, and putting forward really the ultimate conundrum for Japan, which is their economy has been slowing. Their economy relies on their auto industry in a massive way, and potentially some of these tariffs could really impede it. It highlights how difficult it's going to be for the United States to take a friendly line with allies at the same time that they're conciliatory talks with China. And it raises a question of what the United States ultimately wants from some of these classic trading partners.
So that's the latest on Japan. Danny mentioned this. If you look across the equity market this morning, most things are trading high with the exception of maybe pharma stocks. The president is planning to sign an executive order at 9 a.m. Eastern time to reduce drug prices, saying drug and pharmaceutical prices will be slashed by 30 to 80%. And here's the quote, Bramo, almost immediately.
So there are a lot of questions here. President Trump in his first term tried to do something similar to this, and it was shot down in courts. The expectation is this is probably just going to have to do with pharmaceuticals involved in the Inflation Reduction Act, or maybe Medicaid and Medicare. It's going to be challenged legally, but there is this question of how significantly it will draw down prices. Look, a lot of people have said this is unfair. a lot of people don't think it's fair that the United States should be subsidizing the innovation for the rest of the world in the pharmaceutical industry. Question is, how do you do that without impeding that innovation in the pharmaceutical industry in the United States and frankly and elsewhere? And that, I think, is going to be the big battle in the weeks and months to come.
This has been the ongoing tension, as you point out, for years and decades. Let's get back to our top story. International investors weighing the impacts of tariff uncertainty, with some potentially turning away from the US over the past few months. Hugh Van Steenis of Oliver Wyman writing the following. Some large international assets owners are weighing trimming US holdings by 5 to 10% from having been max overweight, as they fret about whether this is the end of US hyper-exceptionalism. Hugh joins us now for more. Hugh, good morning. Good to see you.
Good morning, John. Mate.
Big change all over again, so we've got to keep up with all of this. Let's just think about the last month or so, the round-the-world tour that you've done. And can you share with us just to what extent international attitudes to US assets have changed?
Well, look, the shock of the tariff announcements has clearly, weighed upon international investors, and I think they're trying to rebalance their portfolios. But the bottom line for me is they're trying to think through what is a more diversified portfolio from here. So let's take the easy piece first. If you're an international insurer or pension fund, you've got liabilities in your own currency. International investors have been running at the lowest hedge rate for 8 years. European investors, for instance, own 25% of US credit. So they want to keep owning the US credit, but they need to hedge more. So they're probably going to increase the hedge ratio 10 to 20 points. But coming back to the point about then what they might trim, certainly there's this nervousness about should you trim maybe 5 to 10 points of US exposure. I don't think anyone's doing it now. This is more a kind of question of how does this play out? And events like today will clearly weigh on that. But there's also an element about private equity exposures. People feel a little bit too much in private equity and want to get their weight down, again, maybe about 5 points.
Do you see it as a push dynamic, policies in the United States pushing capital out, or a pull dynamic, better policies abroad pulling capital in?
Well, it's a great question. I think particularly in Europe, where there is now this, fiscal stimulus and a need to really invest in rearmament, infrastructure, energy and so forth, there's a real expectation that European credit could be more interesting. The yield is already wider. And therefore, actually, the bid is interesting. And I think without the FX risk, it becomes sort of doubly interesting for a European pension fund, European insurer, and quite frankly, for a European investor. And I think we're seeing the same in Canada with the Maple 8, where they're also thinking about, do they need to support some of the actions of Prime Minister Carney? So I think the pull factors shouldn't be underestimated.
How much are they saying this in conversations because they're angry? And they feel frustrated, and they feel like they want to be heard. And so they say, we're going to sell our U.S. assets, but we haven't done it yet. We're just looking around the edges. How much is that kind of what you're feeling?
Well, it's a great question, because I think we tried to put this into sort of like a quantitative survey, and no one was then to put numbers behind it. And I think that speaks to the point of good investing, which is you have to make some tactical moves. And clearly there were some people who wanted to get their weight down or reduce their FX exposure. But now it's more about, quarterly committees for strategic asset allocation. No one wants to make intemperate moves. I mean, it's clear that if you go to Canada and France, there is some anti-Americanism brewing, just as there was in the early 70s. So I wouldn't underestimate that as a factor. But I think for most professional investors, they're trying to sort of think through the very short term to what does this mean for the medium term?
Well, when you say that, what does this mean for the medium term? You just noted that a lot of people were looking to trim their exposure in private equity. I find this fascinating because so many people come on this show and talk about how private assets are the way to go to shield you from the volatility of the past couple of months. And you're saying it's the opposite, and that people are saying, actually, we want more transparency and maybe we ought to trim that, especially if there is this volatility and structural changes happening in real time. Is that your takeaway, that actually this could be an asset class that sees quite a bit of volatility, even if it's not priced in real time?
So I think we need to distinguish here between the private equity and private credit. Already coming into this year, public markets have outperformed private equity for the last 3. There was a concern about some of the most recent vintages. And so some of the conversations we've had around, well, can I top slice this a bit? And as maybe the exits have been pushed to the right, and there's real concerns then about, well, maybe I'll recommit, but only when I get the cash flows out. And so as the cash flows get pushed to the right, just simply the maths of it means they're pushed to the right. But as just John said, if they then say, well, look, I wouldn't mind then keeping a little bit just behind just to invest domestically. And actually the biggest theme I've picked up is Canadian European investors wanting local currency denominated private equity funds, that, or at least hedged asset classes. If that's a thing, that's an area where there's interest. I think on credit, though, there's huge demand for credit still. And I think the polarization of portfolios between ETFs or less liquid, I think the the Cambrian explosion of new products here, I still think is very interesting.
As one of the journalists, I'll come up with a catchy headline and you can give me the nuance. The Great Repatriation. How much is in that? A lot of investors just bringing their capital home, seeing the rest of the world as increasingly risky and bringing that money home and investing domestically.
Well, it's a great headline. That's why you're in the media. I mean, the way I see it is rebalancing rather than exodus. I think it's much more about a rebalancing of portfolios to try and look. The bottom line from this is that investors will want greater diversification in their portfolios. They've rode the dollar strongly. It's been a very virtuous cycle. US has been hyper exceptional. As that somewhat trimmed, I think there's a need to maybe reduce a little bit of the dollar exposure, even if it's just through hedging.
How do you see that, beyond just hedging? Is there a bucket of currencies that you want to get equal exposure to? How are people thinking about that? The universe used to be the dollar's at the epicenter of it and everything revolves around it. What is it now and how is that changing, if at all?
Well, I think this is where we need to distinguish between different types of investors. So if you're, I don't know, a Dutch or a Danish pension fund, then clearly you've got to think about the rules and regs in your jurisdiction and make sure you're not having too big a mismatch. Same with the Taiwanese insurers, obviously, which you were talking about only two weeks ago or last week. But I think that, I was with a central bank governor in the last 2 weeks as well, thinking about what they're doing. Actually, it's very tricky to think about what the art move is. Actually, gold was the conversation which came up instead.
How many times has that come up around this table? Gold. Not this table, because this is a different table this morning. We're trying to get back to the old table once we fix the studio. Around the old table, how many times has that conversation came up?
So many people love gold. Everyone's saying that it's the ultimate hedge because it's the only currency substitute that doesn't have hair on it and that potentially could be a constant. That said, gold can only take you so far. We were talking about this last night at the dinner table. Do you bake it down into jewelry so you can take it when you escape? I mean, do you have gold bars? I mean, these are the sort of
discussions. What did the teenagers say?
Well, the teenagers were talking about gold bars, and I explained that they're incredibly heavy and that when you try to carry them from Heathrow to the United States in your big suitcase,
it's difficult.
It was really hard. It hurt your back.
So in the 70s, they put Kruger into a briefcase instead, and it was little, it was coins that you did instead. And actually, the gold vault in Zurich used to be on the main train station, 50 metres from the train station, so people could put it when they came off the flight.
We can share some old stories about that in a moment. Gold's down this morning, by the way. Speaks to this story. We're down about 3.5%. Hugh, it's good to see you, sir.
Thank you
very much. Hugh Van Steenis there of Oliver Wyman. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. Apple shares are rising in the pre-market, up 6.5% after reports it's considering raising prices for its fall iPhone lineup. Sources telling the Wall Street Journal the tech giant does not want to attribute the price hikes to U.S. tariffs on China. Instead, they report Apple will attribute any price increases to new features on the phones. Meanwhile, President Trump heads to the Middle East this week. In the first state visit of his second term, Trump is set to land in Saudi Arabia tomorrow, then visit Qatar and the United Arab Emirates before the end of the week. He's looking to encourage the wealthy Gulf nations to invest in the U.S. And Hamas says it will release 21-year-old Israeli soldier Eden Alexander, the last living American hostage held in Gaza. This comes amid renewed talks between the U.S. and Hamas for a new Gaza ceasefire agreement. Israel's government saying today the release could happen within the next 24 hours. And in a post on Truth Social, President Trump called the developments great news. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. Up next on the program, playing down tariff impacts.
Prices are going to stay stable. Don't buy into these economists who are just not in the real world.
We'll talk to someone in the real world in just a moment. Torsten Slok of Apollo, live from New York City. You're watching Bloomberg TV. Must-watch conversation coming up in about an hour from now. Don't miss this. The Treasury Secretary, Scott Bessent, live on Bloomberg TV at 7:45 Eastern Time, following a 90-day truce with China that slashes tariffs on either party. That's unleashed a major rally this morning in the equity market. Good morning to you all. On the S&P, on the Nasdaq, on the Russell, we're up by 3% on the S&P. On the Nasdaq, we're up by 3.9. On the Russell this morning, up by almost 5. Under surveillance this morning, playing down tariff impacts.
prices are going to stay stable once this policy is done. You got to give the president a chance to run it. But over the next 3 months, this policy is going to show trade deal after trade deal, opening markets, reshoring manufacturing, and no tariff charge if you make it in America. Don't buy into these economists who are just not in the real world.
Here's the latest this morning. Investors counting down to US CPI data due out tomorrow and looking for potential impacts from tariffs on prices. Joining us now is Torsten Slok of Apollo. Torsten, good morning.
Morning.
A major agreement over the weekend to absolutely slash tariffs on both the US and on China. Just want your early reaction to that, your first thoughts.
This removes a major tail risks from the economic outlook. And what's most interesting is that of course means that the growth downside risks that everyone has worried so much about that's coming from no longer having trade between the US and China is just no longer the risk that we thought literally 24 hours ago. So the bottom line is that if we no longer have that risk that was so difficult to quantify, that was so uncertain about how long time it would last, even uncertain about what level of tariffs we were at, we can now look forward and begin to think about what are then the traditional things the Fed worries about, namely inflation, unemployment, and therefore the normal business cycle.
Well, I think everyone noticed then you turned to growth straight away. You said we've removed the growth risks. What about the inflation risks?
Well, that's where Fed pricing at the moment is very interesting. The market is currently not just only pricing 2 cuts. Last week we were pricing 4 cuts. So it's very clear that by removing this tail risk and this risk of a recession, we now have the market saying, well, maybe the growth outlook is not that bad, and maybe therefore, yes, inflation will still go up, but if we still have that GDP growth is going to be still okay, at least for now, we may eventually get a tailwind as a result of removing this tail risk.
You just said something that was very important, which is inflation will still go up. What has already been baked in based on the supply chain disruptions to date that you see as prompting inflation to be on an upward trajectory?
That's right, Lisa. That's why the data, including tomorrow, will be more messy and more complex, because we still don't know now yet what will be the end result. And if the end result really is 30%, then of course we will have a different outlook for inflation than if we are 145%. So, but the bottom line is still we will see upward pressure on inflation. We will likely also now see some upward pressure on growth. So maybe the discussion is that maybe even 2 cuts from the Fed is pricing in too many cuts. The dot plot is revealing that the next move will be cuts. But who knows, maybe we can now get a confidence gain. If we regain confidence among consumers, if we regain confidence and restore confidence among corporates, and also if we restore confidence among foreigners, those 3 forces could potentially be a tailwind to the growth outlook, which ultimately could mean that the Fed might not even be cutting in September as the market is pricing at the moment.
There's a larger question here, which is ultimately, was the time of potential disruption and tariff hysteria short enough to not have really injected any damage, true damage, to the United States economy? Is that your take on this?
I think that is correct, because think about how businesses plan. You get a shock. If the shock is one day, you say, okay, that came and it went. If the shock is a month or a little bit more, 5-6 weeks, as it was this time around, companies begin to think about, hey, do I look at other opportunities? How do I plan even my workforce? We didn't see jobless claims go up throughout this period, which is very good news. But we definitely saw on the corporate side, when it came to CapEx planning, when it came to new orders, when it came to prices paid, that we've seen some very significant differences. So we now need to see in the market those things begin to reverse to more normal levels. So that's why what really was clear through this episode was that corporates were fully aware of how serious the situation was. Consumers didn't really completely, at least in the data, reflect the seriousness of the situation. So maybe the consumers, which is 70% of GDP, is saving us that they were never really impacted in the significant way that corporates had begun to change their behavior.
So should we just ignore the data for the next several months?
Well, at least the CPI number tomorrow is, of course, going to be much less relevant now that we have this change. But I do think that it's still very important to see, well, maybe companies did plan to say, we're going to raise prices on our goods no matter what, even if tariffs do come down. So that's why we still need to figure out this discussion, as Beth Hammack was saying on Friday at the Hoover Institution conference. Namely, companies are beginning to say, well, even if I'm not hit directly by tariffs, I'm actually raising prices because some of my competitors are raising prices. So the fear is that if some of this becomes more ingrained, and this is the core of the Fed's problem, then of course it could begin to lift inflation more.
Consumer price tolerance is important here. We've been debating that for the last several months. That debate just doesn't disappear because we've gone from 145% tariffs to 30, does it?
And let's not forget that core CPI today is still 2.8. And if we now just agreed that there is still a lift coming to inflation, well, the lift might not be the 1% that the Yale Budget Lab and the Penn Wharton Budget Model and the Tax Foundation had suggested. But if that lift is still 0.75%, you still have the problem that inflation is not going down towards the Fed's target over the next 6 months. It's actually moving higher, even with a 30% tariff. And that creates a lot of different challenges, including, of course, on rates and the fiscal problems that we used to also talk about.
To build on what John is talking about, there was a theory that actually if tariffs were only raised a little bit, it would be more inflationary because it wouldn't dampen growth enough to offset some of the inflationary pressures. Are you seeing that as the likely reality going forward? Absolutely,
and there's a huge academic literature about the so-called ratchet effect. Once prices go up of something, it's really, really rare that you see them go down. So if we have a ratchet effect, that now we have ratcheted prices up a bit, well, maybe people now have begun to price in, well, maybe I do need, if I'm importing consumer goods from China, maybe I do need to settle for a new situation where prices will just be permanently higher. So the risk is, in some of the daily data also that's been coming out, is that imports from China of goods has seen also higher price increases. So maybe the worry you can have is that exactly there's a ratchet effect in inflation, and inflation now being more sticky, and therefore, again, rates will remain higher for longer.
If there hasn't been any permanent damage done to the economy, there's this larger question of what has changed, right? Other than the fact that we do have higher tariffs, what has changed in the past some days since April 2nd? And there's a real question about the dollar. There's a real question about treasuries and whether there's been structural damage done to the haven status. Do you think that that's the case, or do you think that this, too, is a genie that has been put back in the bottle?
The key now is restoring confidence. Confidence among consumers, restoring confidence among firms, and restore confidence among foreigners. Because foreigners, of course, have also looked at this somewhat turbulent episode and begun to think about, well, what are the consequences of this? Is this permanent? Is this only this week? Is it also next week? And that high elevated level of uncertainty has been a problem literally for any economic agent, domestic, consumers, corporates, and also foreigners. So to your question, Lisa, I think the bottom line is we need now a period of calm, and where it's very clear where the period is ahead of us, what we need to see, namely restoring of confidence for both consumers, corporates, and foreigners.
And nobody can guarantee you a period of calm at all for this year or beyond that. Torsten, it's question time for the Treasury Secretary in 50 minutes' time. What would you like to hear from Secretary Bessent at 7:45 Eastern Time?
Well, of course, what's very, very important now is that if there is really 90 days coming, I know we have other 90 days until the 8th of July for the remaining countries, but if there is now a period of calm ahead of us, that means that businesses can begin to plan. Businesses can begin to look ahead again and say it's less cloudy than what it was just a few days ago. And I do think that that becomes very important. And the second thing I would also ask about is, well, now we suddenly have this discussion of, well, maybe rates are not going to come down as much, definitely not in the front end, and maybe in the long end, the term premium has also been going up. That brings back the discussion of the fiscal situation and fiscal sustainability, which was less of an issue for the last several weeks, but is now becoming an issue again because now there's more upward pressure on rates, and that creates all these challenges about where on the curve is the T-back issuing and all the things that come around what is fiscal sustainability doing.
Torsten, it's good to see you.
Thank you.
And we will be talking about fiscal sustainability not before too long, that's for sure. Torsten Slok there of Apollo. Lisa, we've got to talk about it. 7:45 Eastern Time. The Treasury Secretary, Scott Bessent, joining us on Bloomberg TV. Lots to ask about. A lot of people believe framing matters. How do you frame this? Do you frame it where we are relative to where we were on Friday, or where we are relative to where we were at the start of the year? Because the tariff story, explained that way, is very different.
And how do you explain where this is in the journey to what end, right? We still don't really understand exactly what the goal is. If both sides are saying that they agree they don't want a decoupling, what do they want? Sustainable investment, sustainable transactions? Do they want some sort of concession from China's side with respect to chips? These are the types of discussion points that are important to unpack.
Equity futures absolutely flying early this morning. Up next, the second hour of Bloomberg Surveillance. We'll catch up with Kevin Gordon of Charles Schwab, Henrietta Treyz of Veda Partners, Jill Carey Hall of Bank of America, and the U.S. Treasury Secretary, Scott Bessent, live from New York. This is Bloomberg.
The markets, I think, for now are in this holding pattern.
Now we're at least getting to some sort of balance, but still definitely a lot more wood to chop ahead.
We're definitely past peak uncertainty, but it doesn't mean we're past peak negativity.
The American exceptionalism trade lives on.
The balance of power and trade remains here. I'm not moving away from kind of the U.S. exceptionalism argument.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now as we secure a 90-day truce between the US and China, leading to an aggressive cut in tariffs on either party, unleashing a massive rally in this equity market. On the S&P 500, equity futures higher. On the NASDAQ, up. On the Russell, up by almost 5% on the Russell 2000. This unlocks higher bond yields across the curve on a 2-year, 10-year and 30-year. Torsten Slok of Apollo saying this aggressively removes recession risk. In the bond market, that means yields are up by 12 basis points on a 2-year, back through 4%. And with yields up like that, expect the euro down like this. Euro dollar negative by 1.5%, the biggest move lower potentially since the day after the election. Euro dollar 110.78. That's the market set up. Plenty of questions for the Treasury Secretary later on this morning. We'll have that conversation with him. 7:45 Eastern Time. Bloomberg Surveillance and the Treasury Secretary of the United States, Lisa, Scott Bessent.
Yeah, there are a lot of questions about exactly what the path forward is. Right now, markets are removing that tail risk. To pick up on what Torsten Slok was saying, 2-year yields now effectively removing, and Fed funds futures removing 2 Fed rate cuts for this year. So only 2 rate cuts getting priced in currently as people take some of the worst case scenarios off the table now. For Treasury Secretary Scott Bessent, the question really remains, how sticky is this? How much can that 90-day sort of pause as they negotiate this with 30% tariffs on China? How long can that continue? To 180 days, to 360 days? And is this the new ceiling? Are we seeing that the ceiling is at 30% and the floor is at 10% and everything else is going to be the negotiating ground?
The good news, it's no longer 145, it's 30. The bad news is it's 30. And not what it used to be. And the framing, I think, matters here. What is more important to you? I think from the market seat, what's more important to you is where tariffs were on Friday. From the economist seat, I think it matters that tariffs are going to be materially higher still than where they were at the start of the year.
Which is a reason why Torsten Slok emphasized that there's this ratcheting up theory in economics, where if you actually increase tariffs just a bit, or not just a bit, 30% is more than just a bit, but not necessarily to a full trade embargo, it actually is more inflationary because people can absorb those price increases and it doesn't necessarily torpedo growth in the same way. So how much does this structurally increase inflationary expectations, even if it's not the worst case scenario?
Session highs in the equity market, the S&P 500 higher by 3.2%. Coming up this hour, we'll catch up with Kevin Gordon of Charles Schwab as a risk-on mood returns to markets. Henrietta Treyz of Veda Partners on a major US-China trade breakthrough, and Jill Carey Hall of Bank of America on why she's still cautious on small caps. We begin this hour with stocks higher as investors rush back into equities on the heels of a US-China trade deal. Kevin Gordon of Charles Schwab writing the following: the best case scenario mostly unfolded. That said, as we're going to learn from other countries, it will likely take a while for meaningful trade deals to form. Kevin joins us now for more. Kevin, good morning.
Morning. Nice to see you.
It's a much bigger move than we expected going into the weekend. How important is this move to you?
I think it's important, well, clearly the market's treating it in a behavioral sense. This is sort of classic behavioral economics where you're coming down from, an insane triple-digit percentage tariff rate to something that is, obviously less aggressive, less extreme. But if you were to just take 30% in isolation, to your point, that's still pretty high. It's still a pretty meaningful shock. But I think to the point around what was mentioned in some of the press releases from the weekend, what I found most fascinating was that they're still pointing to, U.S. trade officials are still pointing to the trade deficit as some sort of national emergency. So I wonder if that's going to be still the cornerstone of all the negotiations, not just for China, but for all the other countries that we're trying to do trade deals with. If that's still going to be the cornerstone, I wonder if that's going to be, a pretty big block in front of us in trying to get to some sort of agreement. Because we have to keep in mind, this is just a framework for getting to some sort of talk, to get to some sort of deal, to maybe get to some sort of form of purchase agreement. So that's a long process, and I think that sequencing is really important to keep in mind.
We're going to have to do some hand signals now, okay? You're going to have to work with me. Soft data was down here.
Yes.
Hard data was up here. How do the two reconcile in the weeks to come? Clearly soft comes up. Yeah. What does the hard data do? And do we ignore it?
I'm not so sure I mean, clearly anything can happen between now and the next few weeks in terms of what goes on with other countries. But I'm not so sure we can expect this massive jump in the soft data, especially because I think what was driving a lot of the weakness in the soft data was just this huge cloud of uncertainty in terms of tariffs being this moving target. That's still the case. Tariffs are a moving target. For China, tariffs are a moving target clearly for the rest of the world, even if you look at the agreement to have some sort of discussion with the UK. There's still that 10% baseline, but there's now going to be some, adjustments around even things like autos after you get to the first 100,000 imports of cars for the UK, so on and so forth. So I think that, and not knowing the firm established rules of the game for companies, at least in the United States, that to me is actually what has depressed the soft data, probably what keeps it a little bit in this kind of muddle through or stasis scenario. I don't see any miraculous resumption until you get a firm, sort of setting of what the actual tariff rate is and what the actual rules of the game are.
That said, have we taken the worst case scenario off the table?
I think, near-term recession risk-wise, what your discussion with Torsten shortly, just a bit ago, I think you've probably taken that off for now. I think, but going forward, if you were to, again, look at this, let's say by the end of the year you get to some sort of established framework for what the baseline is going to be for the rest of the world and then what the baseline is going to be for China. You're still presumably looking at a pretty aggressive increase in the average tariff rate for the U.S. So if you were to just take that, it is still a meaningful supply shock to the economy, but from there, we have to start to work in what the effects are to the economy, but also, to the point you were making at the opening of the show, what is the effect on inflation? How much are companies able to pass this on? Presumably a little bit more so if you were going to have a lower tariff rate that consumers can maybe digest more, but that also hinges on the labor market staying in a relatively healthy spot.
I was looking at the Apple Supermax Pro ultra thin product that's going to be released this fall, and they're considering potentially raising prices on their goods without mentioning tariffs in order to not take it on their margins. I just wonder if stocks are more insulated than bonds right now, given the dynamic you just explained, that potentially we're not going to go into recession, which means that pricing power might be a little bit better, but inflation concerns still very much front and center.
Yeah, I don't know if they're as well insulated, just because if you look at inflation at this part of the cycle versus what we experienced a couple of years ago, the inflation surge that we had in 22 into 23, that was aggressive, but it was also happening at the same time that the labor market was rebounding in a pretty considerable fashion. We don't have that kind of labor market rebound this time. And I would argue one of the main differences now, and you're already starting to see it in some of the data, especially in the tourism sector for the U.S., the services risk, I think, is pretty real at this point in terms of our hit to demand for services here in the United States. And there's often so much focus, whether it's from the trade side of things in the administration or whether it's from analysts and strategists on Wall Street. There's so much focus on the goods deficit. The services surplus that we have with most of the world rarely gets a lot of attention. And I think any potential hit and reduction to services demand here definitely puts us at risk economically because it's a larger part of the economy, but also because so much of the labor rebound has been in the services part of the economy. So if you have more of a risk there, even though everything maybe singly comes down temperature-wise on the goods side, I think you have to pay attention, at least as much, if not more, to services.
It sounds like you don't agree completely with Torsten Slok that there wasn't any damage done since April 2nd. Is that correct?
Oh, no, I think there was certainly damage from a confidence perspective. It's still, we have that wide gap between weakness in the soft data, weakness in the hard data. But, that could be just elongated now, or it goes away if you do continue to muddle through. But I think that if there is a risk to services demand, especially in a labor sense, if you get into the summer season when areas like leisure hospitality tend to account for the bulk of hiring in the U.S., you could still go through that hard data slowdown, but you would have to parse through sector by sector, where the weakness is.
Okay, we're getting into something important. The Federal Reserve's favourite phrase, we're data dependent. And often what we ask is how dependable is the economic data? Yeah. How dependable is the data going to be through the summer?
Dependable, yes, but whether it gives you a clear signal on where the economy is going, that's hard. Because I could see a scenario, actually, where maybe you flip the dynamic that we had over the past couple of years. We had been talking a lot about rolling recessions in the economy. That was purely concentrated on the manufacturing and the goods side. Now, if that stabilizes, because you take a lot of this tariff uncertainty risk in terms of, high percentage rates of tariffs off the table, but you still do have a little bit of slowing in services. Then that gives you another dynamic where, you could have this rolling weakness under the surface, but it doesn't bring overall GDP, down into recession-like territory. Same thing for the labor market. If you still have, relatively constructive data on manufacturing or goods or the cyclical parts of the economy, but services does go through that slowdown, you basically have a flip dynamic from what you had a couple of years ago.
Lisa, this could be a mess for the next several months. I think it's the short way of putting things.
I think that that's correct, because you're going to have a data point, the market's going to react to it, and then there are going to be all the people saying this is the reason why you can't look at this data with any reliability, because it's either bringing forward or it's pushing back. And so suddenly it's a real mess. How does the Fed really operate with this and talk about data dependency as their sort of catchphrase to push people off course?
Chairman Powell speaks on Thursday. I think he's addressing the framework update at the Federal Reserve. That's probably good news for him, isn't it? He can just avoid all this.
Yeah, I mean, I think the goal, even in the press conference last week, I think the goal was to avoid all of this because of the constant response of, we don't know. And actually, when you think about now in the context of what's happened over the weekend, Fed looks to be in a pretty good spot in terms of keeping rates steady. You talk about, the market pricing out a lot of rate cuts this year. Clearly, that's for better reasons, because you don't expect some sort of slowdown to hit from tariffs. But if you have maybe a little bit of a firmer floor under inflation now, the Fed does look to be in a pretty good spot because growth is still firm. I mean, private demand in the first quarter was still running just above 3%. Clearly, we were coming into this year with relatively strong momentum. So I think that, they're probably right to stay where they're at right now because there really is still no visibility. I mean, this is a moving target every single day.
Every single day.
Yeah.
And for the next 90 days particularly. Kevin, good to see you. Thank
Good
you,
to
sir.
see you.
Kevin Gordon there, Charles Schwab. Equities this morning up by more than 3% on the S&P. With an update on stories elsewhere with your Bloomberg brief. Here's Yahara Anand with more. Hey, Yahara.
Hi, John. We start with today's top story. The U.S. and China temporarily lowering tariffs on each other's products in a 90-day cooling off period and stepping back from the brink of decoupling. The U.S. reducing its levies from 145% to 30% and China dropping its duties from 125% to 10%. Treasury Secretary Scott Bessent saying negotiations are ongoing and could include purchase agreements to balance the trade deficit. Meanwhile, President Donald Trump sharing plans to sign an executive order later this morning to reduce prescription drug prices by 30 to 80%, mandating that Americans pay no more than people in countries that have the lowest prices. The announcement put foreign drug makers under pressure, and we're seeing weakness among U.S. drug makers as well. And U.S. Transportation Secretary Sean Duffy saying Newark Airport will see, quote, several weeks of reduced capacity after 2 radar and communications failures in recent weeks. The most recent happening yesterday, an FAA equipment failure leading to a temporary ground stop at Newark due to a telecommunications issue at an air traffic control center in Philadelphia. That's Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, a trade breakthrough.
We have reached an agreement on a 90-day pause. Neither side wants a decoupling.
That conversation up next with Henrietta Treyz of Veda Partners, live from New York City this morning, with equity futures up 3% on the S&P. Good morning. Huge rally this morning, up by 3% on the S&P 500, up by more on the Nasdaq and on the Russell. The Russell 2000 higher by 4.7%. This move in the bond market, 2-year, 10-year, 30-year, unlocking higher bond yields as we push back against the expectation of recession risk. Yields are higher by 11 basis points on a 2-year, 3.99. And in foreign exchange, euro dollar taking a dive. Euro dollar 110.94, a move of 1.4%. Against the single currency, the dollar a whole lot stronger in this morning's session. Under surveillance this morning, a trade breakthrough.
We have reached an agreement on a 90-day pause, substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%. Neither side wants a decoupling.
It's the latest this morning. The US and China agreeing to slash tariffs on one another for 90 days. The US cutting levies on Chinese imports from 145 to 30, and China lowering duties on US goods to just 10%. Bloomberg's Tyler Kendall joins us now for more. Tyler, have we got a view for what takes place over the next 90 days?
Yeah, hey, John. Well, once the pause goes into place by this Wednesday, the countdown's really on. So we're going to be looking for any clues on what it takes from the U.S.'s side, at least, to de-escalate this on a more permanent level, considering that Bloomberg News had asked the Treasury Secretary Scott Bessent earlier today what it would take to not raise those levels back up. And he said ultimately it would be good faith and good dialogue. Now, there are a few differences that we're, of course, tracking. The Treasury Secretary said that he thinks that progress can be made when it comes to fentanyl concerns and that likely purchase orders would be included in any agreement. In an interview earlier today, he said that the Phase 1 trade deal would likely be a good starting point. We're also going to be watching for those non-tariff barriers as China confirms that they're set to remove any non-tariff countermeasures, likely referring to some export controls that they put on critical minerals since April 2nd, long a sticking point with this White House. But at the end of the day, the USTR Jamieson Greer did say that he felt the differences between China and the U.S. weren't as large as previously thought, but we do know that there are still going to be those sticking points going forward. John, one example, we got a new statement from China's Commerce Ministry earlier this morning, and while they said that this was all a good first step, ultimately they hope that the U.S. takes steps to completely rectify the mistake that is unilateral tariffs, as they called it.
Tyler, I'm just wondering if anyone in Washington, D.C. who you speak to can give you color about why there has been such a shift in tone, say, from today, since Friday even, when you're talking about 80% potential number on China.
Well, Jamieson Greer was actually asked about this directly, and he said negotiations are fluid. They're always going to negotiate. We often hear from U.S. officials here at the White House that everything is on the table. Yet at the same time, they still contend that President Trump, of course, is directly involved in the talks and does give his input as Jamieson Greer and Scott Bessent really lead up to the negotiations. But of course, going into this day, as we've been covering at this point for months, there really has been an uptick when it comes to consumers' fears and how particularly the tariffs against China could hurt trade and those prices here at the U.S. The other side of this, too, though, is how it could hurt farmers and agricultural products. That is a really big component that we're going to be watching here, and we know that Republicans are particularly protective when it comes to farmers. As our reporting indicates, the administration was looking at potentially a bailout for farmers down the road if it came to that.
Tyler, appreciate the update. Tyler Kendall from outside the White House. To extend the conversation, Henrietta Treyz of Veda Partners. Henrietta, how do we ensure that 90 days doesn't become 18 months again?
Well, I mean, I think that a lot of the folks that you've had on the show this morning have done the Lord's work in getting the White House to back off of their 145% tariffs. Torsten Slok deserves, in my opinion, a lot of credit with the direction that he's taken in trying to compel the White House to see that tariffs do not work and that everybody loses a trade war. I was sort of reflecting on Mother's Day. There are some kids you can talk to and say, hey, the stove is hot, don't touch it, and they won't. And other kids that have to touch it and find out in the hard way that the stove is hot. So the White House found out, they tried, it did not work. I think it's really important to note that an 80% reduction in the tariffs would not have alleviated the embargo on trade. You had to get below that 50% threshold to get corporations to continue to bring components or products in. So landing at 30% or so is really what we need to continue the flow of trade. And I think that really is a piece of the puzzle between the 80 and 30%. You had to get below 50.
I was the kind of kid that touched the stove. Ramo? Touch the stove?
Well,
test limits?
Yeah, I had to.
Push
yes,
boundaries?
I would once put my finger directly on it, and my parents got very upset. So pretty much.
That adds up. That tracks. Henrietta, I'm not going to ask you which one you were. We know you're obedient and you listen to your mum.
I feel seen.
30%. How sustainable is 30%? The Treasury Secretary said 145 wasn't sustainable. He gave us a decent indication these tariffs would come down. They've come down. Do you see 30% as sustainable if we have no success over the next 90 days?
I do see 30% as sustainable, and here's why. As we learned from the first Trump administration, you can get the White House to capitulate when you offer them concessions along the lines of Phase 1, which is additional soybean purchases, pork, beef, sorghum, lower some of your sanitary thresholds, things along those lines. We do need, as you just discussed, we have seen the Republican Party in the throes of asking for a $60 billion bailout for farmers. That's very expensive, more than double what we saw in the first Trump term. And quite frankly, the conference is about to pass a $5 trillion tax bill. They don't have $60 billion lying around to throw to the farmers. The number one thing that we need to shift to now is if we do not have tariffs on at 145%, we're obviously not going to be getting the $2 trillion in revenue that the president told us all we would be getting as a result of the tariffs. And I think the tariffs on the rest of the globe, the other 90 or so nations that he's put Liberation Day tariffs on, are also not going to come into effect. So Howard Lutnick discussed this last week. We've collected about $46 billion in revenue from tariffs. If we're passing a $5 trillion bill and a big portion of that was going to be offset by the by the tariffs, then we're obviously not going to get that going forward. So we need to find a new offset there. That's why the president is talking about taxing millionaires, et cetera. There's a long way to go.
Henrietta, this is so fascinating, and I'm so glad you brought up the budget. We did get sort of the reconciliation bill, at least in its draft form, on Friday, and people were saying that it would add $5 trillion to the deficit over the next 10 years. There is this question of where the offsets will come from. Based on that bill, what is the expectation for how many revenues get brought in from the tariffs? What's the expectation of what the outlays have to be? You talk about, say, a bailout to farmers. How much is left for that?
Yeah, this is going to be a massively deficit increasing package. To put it into perspective, when I say a $5 trillion package, $3.8 trillion is already spoken for and will be completely deficit financed through the budget gimmick known as current policy baseline. The Senate Republican Conference will not score that $3.8 trillion in spend as costing a dime. So that will be pure deficit financing. Then on top of that, we have to realize that we have narrow margins in both the House and the Senate. So we got to throw money at the SALT caucus, the child tax credit, the earned income tax credit, low income housing. We need to maintain Medicaid subsidies. We cannot cut SNAP nearly as much as they want to. And then we haven't even gotten to the components that President Trump campaigned on, which are massively expensive. The no taxes on Social Security cost $1.8 trillion. We just literally don't have the money for any of this. I think at the end of the day, the market should expect short-term extensions of a lot of this policy. Anything on the business side will be 2, 3, maybe 4 years. They put sort of a 2029 marker in the sand in the reconciliation bill when it was released on Friday night. But most of this is going to be explosively deficit increasing. At the end of the day, I would say anywhere between $4.5 to $5.3 trillion in deficit hikes.
The reason why it's important to analyze this, going back to the tariffs and the reductions between the U.S. and China, there has been a big question. What is the Trump put? Where is the place at which President Trump does change his tone from hardline to playing nice? And there's a question about whether it's been polls. There's a question about whether it's been budget realities and some of the bailouts or inability to pay for them. And there's a question of how much ultimately it's going to rely in markets. From your perspective, which is it?
This time around on the tariffs, it was the markets. I feel pretty strongly about that. I mean, I sort of balance straddle the line between both of those. And I talk with members all day long. And of course, they're upset about the tariffs. They're seeing their constituents come to them and say, you know, my shoe company is going out of business. I can't sell toys. My business has to close. But those members don't really have recourse in the White House. From my seat and talking with investors and seeing the way that they've approached this White House, it has been driven not by the stock market and the ups and downs in the Dow, but by individual analysts trying to make the case to the president about what exactly it is the tariffs do, how this hurts shippers, truckers, the cargo areas, retailers. This will spike unemployment. I mean, they literally had to teach the White House in real time exactly what the economic feedback was going to be and show them consistently for weeks exactly how bad it could get. And I think they were the ones who deserve the credit here.
Henrietta, appreciate the framing. Henrietta Treyz there of Veda Partners. I go back to that weekend when the president's on Air Force One. Annmarie's alongside him, and in the background is the Treasury Secretary, Scott Bessent. And the bond market's just made a move. And I think we know what unsettled the administration. When growth expectations were coming down and bond yields were going up, that's when this administration started to get a little bit nervous.
It was sort of a 1, 2, 3 punch because you saw the bond yields go up and then you had that meeting with Walmart and Target executives where they laid out clearly, we don't know the exact contours, but it seemed like they laid out what would happen and the potential for empty shelves. And that real time playing out in markets and rhetoric seemed to have really shifted things in the White House.
And this right here is the latest stage of negotiations. To be clear, the negotiations continue, this time with a lower tariff level, but still around 30%. Equity futures on the S&P up 3% this morning, up more than 20% from the lows around the first week of April. This rally has been vicious. Up next on the programme, on a vicious equity market rally, Jill Carey-Hall of Bank of America. 2 hours away from the opening bell, and equity futures near session highs, up by more than 3% on the S&P 500. The Russell, the small caps, up by close to 5%. So many movers out there this morning. Let's get 3 of them for you. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Look, there have been questions that if we eased off of tariffs, that there was de-escalation, what would lead? It seems that at least for today, we have the answer, and it is Mag 7, and it is big tech, the entirety of the sector higher. Apple in particular interest this morning up 6 1/3%, because along with that, there's also a journal story out this morning that they're considering raising prices of their iPhone, but trying not to tie it to tariffs. Instead, if they do it, it'll look something like they're tying it to product launches. So those shares moving higher. Also higher this morning, all of the airlines, another sector that is a clear outperformer. Take a look at Delta, for example, up 7.3%. They're one of the first companies out of the gate to say that they are removing their outlook and concerned about the consumer. Perhaps those concerns, at least some of them, get erased if we don't have to price in a recession, so airlines do better. We'll see if there are any updates from the corporates on those levels. One sector, though, decisively into the red, not participating in the rally, is healthcare. A 1-2 punch. This is a safety sector, so you don't really need it as much if we are risk on. And second, over the weekend, Trump posting on Truth Social that he is looking at lowering drug prices between 30 and 80%, matching the lowest rate that countries pay for drugs. So shares falling as much as 4% for Gilead. John.
Hey, Danny, thank you. We'll get back to that story in just a moment. On our radar this morning, our top story, a US-China trade breakthrough. Both sides agreeing to lower tariffs over a 90-day cooling off period. The US slashing levies on China from 145 to 30, and China slashing duties on US goods from 125% to just 10%.
There are a lot of details that still need to be revealed, a lot that still remains unknown. Nonetheless, this feels like a sea change. It certainly is being reflected that way in markets where suddenly people are saying, and we heard this from Torsten Slok, the worst case scenario of recession has been taken off the table. The tail risk has now not necessarily materialized in the same kind of way. The cooling intentions has removed that chance, and you could see that in the Fed funds future with now just 2 rate cuts priced in for the Fed this year.
You can see it across the board. It's being priced as a positive growth shock this Monday morning. Tariffs dropping by much more than people thought they would, anchored by the president going into the weekend, who suggested something closer to 80, and we've landed at 30. Yields are up, the dollar's stronger, equities are higher by 3%. Later, you'll hear from the president. At around 9:30 Eastern time, the president set to sign an executive order aiming to cut U.S. prescription drug costs. Trump saying on Truth Social, quote, prices will be reduced almost immediately by 30 to 80%.
It seems like 30 and 80% are really making frequent appearances here in terms of numbers. Look, this is an issue that has been a longstanding one in the United States. U.S. consumers spend a lot more per drug than other people in other countries, and drug makers argue that this higher price is necessary to subsidize some of the innovation that they do, as well as new drug creation. President Trump in his first term tried to do something similar. It was knocked down by the court system. This is likely just to target the Inflation Reduction Act and drugs covered under that. There also is probably with something that he'll try with the Medicare and Medicaid. It raises the question, what can he do? And also, how much are the courts going to really knock down in all of the ongoing negotiations and proposals that we keep seeing?
It's also what they charge insurance companies as well. That's the big problem, too. Living here in the United States for the last decade or so, just unbelievable when you get the breakdown, what's actually being charged to insurance, and how inflated, can I say inflated, how inflated it all feels?
Well, because what they charge insurance is a fraction of what you would get charged if you were out of pocket. And if you're uninsured and you go to a hospital, for example, and you're given care, it's often 3 or 4 times as much as somebody who comes in and then has to go back and charge the insurance companies. There are all sorts of strange and seemingly unfair aspects of the healthcare system. How you're going to undo some of that with an executive order, I think a lot of people remains to be seen. But I think the overarching idea is something a lot of people can get behind.
The system is incredibly complicated, that's for sure. The president will go on a road trip very shortly. He's traveling to Saudi Arabia, Qatar and the United Arab Emirates this week. Axios reporting Trump aiming to return with $1 trillion, yes, with a T, $1 trillion worth of deals and investment pledges in place.
There is so much that potentially could happen, especially as the Iran-U.S. talks continue, especially as we talk about that plane that Qatar is going to potentially gift President Trump. A real interesting aspect of this, and this is something that a number of people have written about, is there seems to be a convergence of some of the personal and presidential interests in this region that seem to be converging and potentially will lead to a friendlier atmosphere. Curious to see what potentially comes from these trade negotiations.
Annmarie on the ground in the Middle East. We'll hear from Annmarie tomorrow on the president's trip. Let's turn back to equities. The Russell is absolutely flying. Small caps seeing a boost as the US and China agree to reduce tariffs for 90 days. Jill Carey Hall of Bank of America staying cautious, writing, corporate sentiment has plummeted for small caps this earnings season. Small caps still struggling to get out of their earnings recession. Jill joins us now for more. Jill, good morning.
Good morning.
This clearly helps sentiment. Does it help anything else?
It does help sentiment. I think the question is, how are the headlines going to progress from here? How much damage has already been done? There's a lot of uncertainty, and volatility certainly doesn't help small caps. So, if we're in an environment where the corporates still hold off on spending, small caps do tend to be very sensitive to CapEx as beneficiaries. And they've been in this environment where everyone expected more than a year ago that last year, small caps would have seen a big recovery out of the earnings recession. That never happened. It got pushed out. It's continued to get pushed out. And this earnings season, we saw that corporates were pretty cautious. In both large and small caps, guidance was weak and more sparse than it historically is. And as mentioned, small caps did see, when corporates were talking about conditions on earnings calls, a much bigger deterioration.
Just to sum up earnings season so far, how were we rewarding both beats and guidance coming from some of these companies?
Yeah, guidance definitely mattered more when we looked at the S&P 500 reactions. The companies that beat, there wasn't necessarily much reward. The ones that missed got punished. But the companies that were issuing guidance, when we looked at annual and quarterly earnings guidance, that tended to drive reactions more. And that was in tandem with, as we said, guidance that was a bit sparser than history, more uncertainty on the outlook. We saw the same during COVID. A lot of corporates pulled annual guidance. So that tends to happen during these uncertain periods.
I remember long ago and far away in December when people were saying that small caps would actually benefit more than the big caps because they were more leveraged to the United States economy, which is the rocket ship, and not necessarily exposed to international trade in the same kind of ways. Why has that fundamentally so failed?
Well, I think, I think more than ever, this is a time when you need to be selective in small caps. It's not as easy as just buying or selling the Russell 2000. The index has seen shifts over time. It's become more global. So, the gap between the foreign exposure of large and small caps has been narrowing over time. These companies, even though they are more domestic, they may not be as nimble to shift, supply chains and things as conditions change. And they have been struggling, in this earnings recession. They have struggled to get out of it. They've seen a deterioration in quality of earnings over time. So I do think that these companies, there's still a lot of opportunities given how cheap the size segment has gotten. We do like mid caps over small, so I think tilting up the cap spectrum within SMID makes sense. Less sensitivity to volatility and tariffs. The earnings revision trends have been better in mid, but focusing on small caps that have, stronger, more solid margins. Those stocks have been outperforming in this environment with tariff uncertainty. Focusing on stocks that have positive revisions as revisions were still coming down. Focusing on quality. I think that those attributes make sense.
I'm so struck by Walmart when they came out and they said, we're going to invest in price. This, to me, was the clarion call of how much power some of the largest players have in the commerce sector in particular. The idea that they can absorb some of the increase in costs in order to keep customers and possibly gain market share. How much are we going to see that pretty much across the board, with essentially the largest players gaining even more market share and the smallest ones really losing?
Right. I think the ability to increase prices is a key factor. Small caps historically have generally had good pricing power when we've been in inflationary environments historically. But as we've seen, the quality of the benchmark deteriorate over time, and the fact that we're in an earnings recession still for these companies, that's one challenge. We're also in an environment where if the Fed is not able to cut and inflation has been staying high, that's another big factor that's been driving the Russell 2000 is, Fed expectations, since these companies are very leveraged relative to history. They have a lot of shorter-term or floating rate debt. So the Fed has been a big driver as well.
Retail's had a massive role to play. Lisa, I'm so pleased you brought up that headline. That was one of these standout comments of the last few months. And when we speak to Oliver Chen later this morning, we need to talk to him about it. Pricing strategies. How do they shift now? We've had this massive shift again over the weekend.
And we heard from Apple how they're potentially toying with a new pricing strategy of potentially raising prices, because right now it is becoming increasingly clear, even at 30%, this is not going to be something that can easily be absorbed by suppliers. It's either going to have to come from margins or it's going to have to come in the form of price hikes.
Apple up in the pre-market by 6%. Jill, it's good to see you.
Thanks.
Thanks for dropping by. Jill Carey Hall there of Bank of America with an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. The U.S. is suspending imports of live cattle, horse, and bison from ports along the southern border due to the spread of the screwworm pest in Mexico. Mexico's agriculture secretary expressed disagreement with the measure, but hopes for a swift resolution. The import suspension will be reviewed in 2 weeks. Meanwhile, after 4 days of clashes, India and Pakistan agreed to a ceasefire on Saturday. The U.S. says it helped mediate the de-escalation, but India maintains the truce was a result of bilateral talks. A top Indian envoy telling us here at Bloomberg the dispute over Kashmir is bilateral, not international, rejecting any external mediation. And Nissan will eliminate 11,000 more jobs than it previously planned. That would bring the total number of layoffs to 20,000. That's according to Japan's national broadcaster, NHK. The automaker's moves come as part of a wider plan to restructure its business as it deals with weak sales in the U.S. and China. That's Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, a major de-escalation.
We have reached an agreement on a 90-day pause. Neither side wants a decoupling.
Up next on the program, we'll catch up with the man himself, the Treasury Secretary, Scott Bessent, joining Bloomberg TV next. Live from New York City this morning. Good morning to you all. Equity futures near session highs on the S&P 500, firmer by 3% on the S&P, up by closer to 5% on the Russell 2000. Under surveillance this morning, a major de-escalation.
We have reached an agreement on a 90-day pause, substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%. Neither side wants a decoupling.
Here's the latest this morning. The US and China agreeing to a 90-day cooling off period. The US reducing its levies on Chinese imports from 145% to 30%, while China cuts duties on US goods from 125% to 10%. Joining us now to discuss, the Treasury Secretary, Scott Bessent, a driving force behind trade talks in Geneva over the weekend. Mr. Secretary, welcome back to Bloomberg Surveillance, sir. It's good to see you.
Good afternoon from Geneva, Jonathan.
Great to catch up as always, sir. Let's get into these talks over the weekend. One standout line for me and for many others was the line that the differences between the two sides weren't as large as we thought they would be. What were those differences, sir, and why were they smaller than you expected?
Well, I think, Jonathan, what's important to know is for the tariff program, we had a plan, we had a process, but we did not have a mechanism for engaging with the Chinese. So China was the only country who escalated their tariffs in response to our reciprocal tariff level. So that resulted in an unfortunate escalation. So we now have a mechanism to deal with that. Neither side wants a generalized decoupling. The U.S. is going to do a strategic decoupling in terms of the items that we discovered during COVID were of national security interest, whether it's semiconductors, medicines, steel. So we still have generalized tariffs on some of those, but both sides agreed we do not want a generalized decoupling.
These things take time. as you know, sir. We've got 90 days now to work with. Last time around, it took 18 months to reach an agreement on purchase agreements. I think you yourself have said in the past that it can take 2 to 3 years to have a full comprehensive trade agreement with the country between the US and China. What do you think is achievable, sir, over the next 90 days?
Well, Jonathan, we're going to see, but what has to happen is it has to be fair for the American people. But in January 2020, President Trump produced a template. We had an excellent trade agreement with China, and the Biden administration chose not to enforce it. The Chinese delegation basically told us that once President Biden came into office, they just ignored their obligations. So, we all already have a large framework. The other thing to remember here, Jonathan, is that this is a pause down to 10%. The April 2nd level for China is 34%. So we will be working to see where their final reciprocal number ends up. And the negotiations are a combination of tariffs, non-tariff trade barriers, currency manipulation, and subsidies of labor and capital.
Just to build on that, as I listen to you, do you consider the new levels as a ceiling or a floor?
Well, it's obviously a floor that they are now with everyone else who did not retaliate. So the levels have come down to the pause level. And what I would say is 34, which is their assigned April 2nd level, would be a ceiling, which is what I went out and told people on April 2nd, which is why I was surprised market participants panicked, because we had capped the upside for every country, and if they didn't retaliate. So this unfortunate turn of events happened because of retaliation, but now we have a process in place to avoid escalation like that again.
Secretary Bessent, just to build on that, are you saying that tariff rates will only go up from here if this really is a floor of 10% on the Chinese side and 30% on the U.S. side?
I'm not saying that they're going to go up, but it would be implausible that they would go below 10.
One thing that you've been talking about is a generalized decoupling as something that's not necessarily in the interest of either side. Neither side wants that. What about a strategic decoupling? What is the appropriate rate of tariffs that could potentially cause some sort of strategic decoupling in the sectors that you are talking about?
Well, look, bringing back our strategic our important strategic industries can be a result of tariffs, but it's also a result of national will. So this administration is running full speed to make sure that what we saw during COVID never happens again. So it's a combination of, it can be tariffs, but again, it is the administration moving as quickly as possible to make sure that we are self-sufficient in the strategic industries.
I think that's completely understandable from the United States side. And I wonder, Mr. Secretary, whether the Chinese understood that. Did you get the sense they do understand that that will be the road forward for the United States?
Well, I think they understand that, and I think they understand that we are focused on fair trade, that this gigantic deficit that we have with them, that it didn't happen last year, it didn't happen the year before, it's happened over decades, and that this has to be remedied. The China shock gutted our manufacturing sector, and we want to bring that back. On the other side, Party Chair Xi has said that he would like to increase consumption, but to date, the Chinese have just increased manufacturing. So we would like to see them increase consumption. We would like to see them open their market to American products. So there are two ways to rebalance. One is fewer Chinese goods in the U.S. market. The other is more American goods in the Chinese market, and my guess is that the answer is somewhere in between.
Some of this, of course, takes us back to the purchase agreements of the first term of the president. Is it different this time around? Is it as simple as just revisiting those purchase agreements, or do you see additional sectors being targeted?
Jonathan, I think everything's on the table, but the Phase 1 purchase agreements is a very good roadmap, because I will point out that during 2020, China met their obligations under that agreement. It was only under President Biden where they neglected them. So we are starting there. And look, the world has changed, products have changed, product mix has changed. So I think everything's on the table. But the main thing here is we have to have a fair deal for the American people. And keep in mind, too, that we also have 20% fentanyl tariffs on. So we are at, for 2025, we have put on 30% tariffs. They have put on 10. And my economic observation is that businesses just need time to calibrate. That we saw approximately 20% tariffs from President Trump's first term. Businesses calibrated, supply chains moved. We have seen 20% tariffs President Trump put on in February due to the fentanyl crisis, calibration, very little disruption, and now a 10% additional tariff should mean very little disruption.
Mr. Secretary, a lot of people are wondering what caused the softening in tone. The reason for both sides to come together and be able to have this kind of negotiation and chart a path forward where there will be further negotiations in the near term. What's your interpretation of what caused both sides to come to the table?
Well, I think that the two levels on the reciprocal tariffs, when they both ratcheted up to 125, caused the equivalent of an embargo. And that wasn't good for either side. We're the deficit country, so less bad for us. But I think there was the unintended consequence of this very fast ratchet. And so now both sides are at 10. We will be moving forward with a 90-day pause. And the important thing to remember is we can always go back to the April 2nd level. But my sense is we had very good discussions. My counterpart was very firm, but very engaged. And I think we have set the stage for meaningful discussions.
Mr. Secretary, is there already a scheduled date for Xi Jinping and President Trump to meet in person at any point in the near term? Do you think that that is something in the cards as part of these negotiations?
I think that there would be a phone call before a meeting, and there's nothing on the calendar, but I could imagine that could happen in the coming weeks or months.
Going into the meeting, as you know, the president put out a social media post. He referred to you as Scotty B. I won't go there. We'll keep using Mr. Secretary. And he said you could go as low as 80. Can you share with us how we went from, say, 80 down to 30? Where did that number come from, sir?
I think that in the president's mind, 80 was a number that did not cause an embargo. So we could still be at 80 and have trade flowing, but we were able to both move down by 115%. And Jonathan, I think the other important thing here is I think this is the first time that the Chinese have addressed one of the president's real priorities, which is ending this fentanyl crisis in the United States. So they brought their trade team and they brought a vice minister for state security who met with our national security team. It was a separate meeting, and they had a very robust and detailed discussion on ways to stop the transport of precursor drugs from China to North America that ends up in the hands of the cartels, that is then killing several 100,000 Americans a year. So I'm very optimistic that President Trump, we have solved part of the fentanyl crisis by securing the border, and I think this is the next step on that. So if over the coming months we were to see excellent engagement from the Chinese and solutions towards solving the fentanyl crisis, I think we could see some amount of the fentanyl tariffs perhaps come off, but that is going to take actions from them.
What kind of action specifically, sir?
Well, we can see where these precursor drugs are coming from. At Treasury, our Financial Criminal Enforcement Network has very good visibility into international finance. We can see these Chinese companies that are selling the equipment for making the pills, that transferring the precursor drugs to the cartels. U.S. Treasury has declared the Mexican cartels foreign terrorist organizations. So working with Chinese leadership to stop this would be a very tangible symbol. In China, the narcotics distribution is punishable by death. And we're not pushing for that necessarily, but we are pushing for very, very strict enforcement, similar to what they do at home.
Mr. Secretary, I imagine you're incredibly tired, and a lot of people were very excited to see you taking the lead in these discussions, certainly in the market. Are you going to be taking the lead going forward with other difficult negotiations around the world with different trading partners?
I've been involved in most of the Asia negotiations. We had a very good negotiation with, or we've had 2 rounds of negotiations with Japan. I've been involved with Korea. I've met with Vietnam and, excuse me, also Indonesia. So my focus has been on the Asia region thus far. And then the trade team had a great victory with the UK, putting together the contours of the first trade deal. The other thing I want to say, too, is my partner here in Geneva, Ambassador Greer, was an incredible asset. He has years of experience, a broad and deep knowledge of trade negotiation, of the numbers and the nuance, and we would not be here today without Ambassador Greer.
Mr. Secretary, just before you go, you've promised us a lot of time. We've used up most of it already. Just a final question. What does victory look like for you in 6 months' time when we get to year end? And I know it's frustrated you that we've only been talking about trade, that we haven't focused on the full policy platform. Where do you want to be by year end?
Well, look, Jonathan, this administration is doing peace deal, trade deal, tax deal. I try to stay mostly, as you know, in my econ lane. So from that lane, victory to me looks like the 3-legged stool that really, or the 3 parts of our program really kicking in. So we will have most of the trade and tariffs settled. The tax bill is moving along very well, better than I could have imagined. Speaker Johnson, Leader Thune are doing an incredible job with President Trump's leadership. So we will have tax done. And then the final piece that is longer lag, but perhaps the most important, is deregulation. And deregulation, we are deregulating across all industries every day. President Trump is committed to, for every new regulation, 10 comes off the books. And deregulations should start kicking in the 3rd and the 4th quarters. So tax, trade, and deregulation all coming together at the end of the year, I think it's going to be very powerful for President Trump's economic agenda.
Mr. Treasury Secretary Scott Bessent, we appreciate your time, sir. From Geneva, very generous with your time. Thanks for being with us right here on Bloomberg Surveillance. From New York City this morning, good morning to you all. If you're just tuning in, a major rally in this equity market on the S&P 500, higher by more than 3% on the S&P, on the NASDAQ up by 4%, on the Russell 2000 up by 4.6%, as the United States and China strike a 90-day truce, which also leads to an aggressive cutting of tariffs on either side.
Going down from 145% from the U.S. side on China down to 30%, and on China's side going from 125% to 10%. What we heard there just now from Treasury Secretary Scott Bessent was that 10% is likely a floor. It is implausible that it's going to go below that. It is significantly below, however, where they were before April 2nd. So here are the questions. What are the contours of negotiations, and can they get something done by the end of the year, which he said as well?
Stacked 60 minutes coming up to react to all of this. Coming up in just a moment, we'll catch up with Meera Pandit at JPMorgan. As the US and China reach a breakthrough, we'll talk to Oliver Chen of TD Cowen, looking ahead to retail earnings this week. Seth Carpenter of Morgan Stanley ahead of the latest read on inflation tomorrow morning. But we begin this hour with global stocks soaring as the US and China take down the temperature. Meera Pandit of JPMorgan writing, "We do not want to be lulled into a false sense of security. While the volatility we saw in April may have been the high watermark, that doesn't mean volatility is behind us altogether." Meera joins us now for more. Meera, good morning.
Good morning.
Have we put all the bad news behind us?
Not necessarily. What we have to be mindful of is volatility and the nature of it. It comes and goes. And while we have another recalibration moment, we had April 2nd announcement of tariffs. We had April 9th pause on tariffs. Now we have a big reduction for a period of time in the Chinese tariff rate, but there are still risks ahead. We have to continue to follow the ebb and flow of trade optimism, trade disappointment, and there's also a distinction here between when the market stops caring, but the economy is still going to care. Think about Brexit. You know, we're 10 years on almost from Brexit, and it's undoubtedly still an impact on the economy there, even though it's not showing up in markets on a day-to-day basis. So this is the squaring of the circle that we're going to have to go through over the next couple of years, because having a 2% average import goods tariff rate last year to something probably still in the double digits when all of the dust settles is going to have that longer term pass through to the economy. And that means where the economy and markets meet is around profitability.
Before we get into the next couple of years, can we deal with the next couple of months? How will you digest the incoming information? What will you ignore? What will you choose to put some weight on?
What I want to choose to put weight on the most is how our price is impacted. Because as I mentioned, the link between markets and the economy in the long run is going to be the profit picture here. And profits are really going to determine how well stocks can do. Because ultimately, we're already in an environment where valuations are still, compared to their long-term averages, 20% higher than they perhaps should be on an average basis. And so when we think about what underpins that, we have to see that profitability. Now, we have to recalibrate a little bit around economic growth expectations. We were at a 50-50 recession probability coming into this. Perhaps now that is skewed towards slower growth as opposed to definitive mild recession. So in that case, still slowing growth means slowing profit growth. How do we continue to see profits playing out this year? What are the risks from tariffs? Well, you have potential revenue slowdown. How much? You have potential pricing increases. How much gets passed on to an exhausted consumer versus how much get absorbed by historically very high margins? And then you think about even the structures within the S&P 500. Could areas like the Mag 7 be a saving grace this year as some of those areas are more resilient? And we see yet another delay in terms of broadening out of profits. There are so many angles to this tariff and non-tariff as we reconsider what this pause means.
I can feel a bit of frustration, if not for you, for me. I was reading your notes and you were talking about a 50-50 recession call. And I was going to ask you about that. You already brought it up and said probably it's skewed more against recession than for recession. But how do you switch your views so quickly, right? I mean, we're going to see just a complete downgrade of the potential for recession risk across Wall Street if these new rates of tariffs stick.
You have to think about scenarios, and certainly in this environment, extreme scenarios. What if tariffs come off altogether? What if we go right back to where we were April 2nd? Where do we land in between? And clearly, we're probably going to be somewhere in between, and that in between is so hard to figure out when we think, okay, look at what's going on with yields, for example. You're seeing yields start to perk back up. If one of the factors that's been weighing on yields has been lower growth, and all of a sudden that is potentially alleviated to some extent, then you have yields moving in a different direction here. I mean, everything in the market, whether it's equities or fixed income, has been so sentiment driven this year. It's really hard to ground yourself. It's trade fears versus trade optimism, and you're switching back and forth. So we are trying to figure out where to ground ourselves in the in-between state, which we're likely going to end up in.
Where is that place? Is that gold?
Well, not necessarily. I mean, when I think about portfolio positioning, in a way, that's what's changed the least because of some of the starting points that we're dealing with. I mean, there's still definitely two-sided risks to bond here when we think about maybe you don't see so much of a growth slowdown, so there's a lot in terms of term premium that could potentially be pushed up when we think about uncertainty. On the other hand, when you think about the basic dynamics of if we were to see on the ag bond index a 1% rise in rates, certainly not what we expect, you'd be looking at a sell-off of about 1.5% over total return a year in your bond allocation. So you're still actually looking at somewhat of a contained impact there. And despite overall yields biased upwards, you've actually seen that most areas of the bond market have been positive. On the other hand, a 1% fall in rates, not something we expect either, would give you at about an 11% return given that income cushion. So being broadly diversified within fixed income has worked. I think it will continue to work. And on the equity side, you're still dealing with high starting valuations and growth. We want to make sure we're geared towards some of the areas that have been a bit more favorable, whether it's value, outperforming growth about 6% this year, or international, outperforming 14% in dollar terms this year. None of that really changes despite the 30%, 80%, 50% tariff rates.
You're getting to something really important, something that John and I were discussing earlier this morning about how much structurally there has been a loss of dollar exceptionalism and a loss of haven status. And the shift to Europe has been something more sustainable and not just a knee-jerk reaction that was a positioning squeeze. You're saying on one hand, maybe a little, but not necessarily wholesale when it comes to the loss of treasuries as a haven status. How do you sort of understand what has changed since April 2nd?
I think what has changed is certainly that uncertainty level where when there is uncertainty, people want to go to treasuries. And more recently, when there is uncertainty, people don't because a lot of that uncertainty is emanating from the U.S. I think it's also just the compounding effect over time of having unsustainable debt and deficits and that really starting to feed into the bond market given higher rates and the cost of servicing debt overall. These things putting that upward pressure on yields. And I think that people are putting a microscope to some of those elements because it doesn't feel like we're in an environment where some of that direction of travel is going to be for a more grounded place.
This comes to scarring. How much scarring will we see post April 2nd, even if we do secure some major deals in the coming weeks?
There are some things you can't unsay. I think that's going to be the theme for the rest of the year, where even if you do come up with a number of trade deals or more likely frameworks for longer term deals, there's always that possibility that things can potentially come back around. And so there is that scarring there where if you're a business, you're seeing a lot of buybacks. Hey, what's the best use of my money right now? Let me just double down on my company while prices have gone down as opposed to put forth money for future investment. So maybe it's less about people changing their plans, but just putting their plans on hold. And in some ways, over time, that can be equally damaging.
Meera Pandit of JPMorgan Asset Management. Equities at the moment, if you are just joining us, positive 3% on the S&P 500, seeing a bigger move on the NASDAQ, a bigger move on the Russell. In the bond market, yields up across the curve, particularly at the front end of the curve where yields have been higher by close to double digits through most of this morning. And that has underpinned a massive move in the dollar. The dollar a whole lot stronger against things like the euro. The question mark over the last few months is whether we would see some scarring on dollar-denominated assets. And the question this morning, Lisa, is how repairable some of those issues are.
Yeah, and the fact that we haven't seen the dollar reclaim some of the highs or some of the levels that we saw the strength before April 2nd is notable. Also notable, how much is being driven by just a relief trade and how much is being driven by a rate differential. Again, all of these things people will be discussing as this chapter is not done. Let's just be real clear.
We've got a 90-day truce. The dollar is stronger by more than 1%. Up next on the programme, we'll get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Treasury Secretary Scott Bessent telling Bloomberg Surveillance it would be implausible for U.S. tariffs on China to go below 10%.
This is a pause down to 10%. The April 2nd level for China is 34%. So we will be working to see where their final reciprocal number ends up. I'm not saying that they're going to go up, but it would be implausible that they would go below 10.
His comments, of course, coming after the U.S. and China agreed to lower tariffs over a 90-day cooling off period. Meanwhile, President Donald Trump sharing plans to sign an executive order later this morning to reduce prescription drug prices by 30 to 80%, mandating that Americans pay no more than people in countries that have the lowest prices. The announcement put pressure on foreign drug makers, and we're seeing weakness among U.S. drug makers as well. And a check on Apple shares. Those are rising 6% in the pre-market after reports it's considering raising prices for its fall iPhone lineup. Sources telling the Wall Street Journal the tech giant does not want to attribute the price hikes to U.S. tariffs on China. Instead, they report Apple will attribute any price increases to new features on the iPhone. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next, the morning calls. Plus, we'll catch up with Oliver Chen of TD Cowen as the retailers get set to report this Thursday retail sales and earnings from Walmart. The opening about 1 hour and 16 minutes away, with equity futures near session highs on the S&P 500 higher by more than 3% as a trade truce between the US and China unlocks some big gains in the equity market and some losses in the bond market. Let's get to the bond market. 2-year, 10-year, 30-year yields are up by 10 basis points at the front end of the curve, around 4% through most of this morning as we push back rate cut bets and reduce recession risk. That means with those moves, a stronger dollar against the euro. Euro dollar a whole lot negative. We're down by 1.3%, 111 on the euro. That's some of the cross-asset price action. Let's get you some morning calls. First up, Wedbush removing Alphabet from its best ideas list, citing uncertainty around the impact of AI. The stock is up this morning. Like all the other stocks, it's up by 2.7%. Your second call from Jefferies upgrading Marriott to buy, expecting its business model to grow despite an uncertain climate. That stock also higher by 2.6%. And finally, Bernstein downgrading Target to underperform, saying credit card data points to, quote, a bleak picture for the company's first quarter. That stock also a whole lot higher off the back of that trade truce. Target's higher by more than 5%. Let's stick to the retailers. Consumer spending in focus this week as a slew of economic data and Walmart earnings set to show tariffs' impact on prices and sentiment. Joining us now is Oliver Chen of TD Cowen and the Columbia Business School. Oliver Chen, good to see you, sir.
Pleasure to be here. Thanks.
Big deal over the weekend. They got a big excuse to raise prices if they want to. Are they going to take it still?
We'll see. The consumer is fragile. And retailers that we like, such as Walmart and Costco, focus on low prices and passing through as much savings as possible to the consumer. That being said, the prior tariff scenario did necessitate price increases, especially with apparel and toys and electronics. So we'll see. I think what we'll see at the best retailers and the most scale retailers is not passing through prices as much as possible. As you know, Costco is not even a retailer, it's a membership model. So it's looking to really give you the best deal humanly possible on a lot of goods.
A lot of these companies have tried to shift their exposure to China, but let's just work with China. Tariffs have come down, or are coming down, from 145% to 30%. Clearly a big difference. What's the difference between where they were at the start of the year and 30% for these retailers?
Yeah, as we look across the sector, EPS cuts in our models were 30% plus. Now it's around 10%, and it depends on the nature of the price increase you can get. It also depends on the nature of sharing this with the supplier. Those retailers that were most vulnerable were very discretionary, like Target, like Gap, like others in department stores. They'll see the most upside today on this rally, as they were the most impacted. That being said, our investment thesis continues to be bifurcated. When you own Walmart, you're owning needs plus wants. You're owning discretionary plus grocery. And that's a great strategy in terms of what we're thinking thematically, because you'll capture that discretionary and you'll still capture the grocery, the value orientation of the consumer.
I love the idea of companies adapting and adjusting. Tom used to talk about it all the time, and I think that we're seeing that increasingly. And there's this question of how much can companies negotiate with their suppliers, and how much do they have pricing power, and how much do they have other lines of business that can really bolster their margins so that they can really compete on price. How much is Walmart setting the standard for competing on price, for investing in price, for essentially trying to get market share by not necessarily raising prices at all.
Yeah, it's the history of the company, the everyday low price strategy and passing to the consumer. At the same time, Walmart's been pushing into AI, pushing into marketplace models, pushing into digital advertising, where those are high revenue streams that they can balance against the everyday low price, a low margin grocery business. So it's a bit of the mixture. As you think about agility, AI, adaptive retail, and supply chains, speed is the name of the game. We focus on this at Columbia. The simple fact of retail is getting things faster between supply and demand. And they've done a better job than Target at lead times, for example, in the home category. So that's something all retail is focused on. Bottom line, Walmart has so much scale, so much negotiating power with suppliers. That's a key positive, too.
How much consolidation are you expecting on the heels of this? I mean, it sort of accelerates a trend that already has been in place, which is that the big get bigger, the more luxury get more luxury, and they consolidate some of the demand. How much are you seeing sort of a winner-takes-all type of moment in retail?
We're definitely seeing that. I toured a lot of the facilities with Walmart, the supply chain facilities, and it's intense robotics. It's a lot of use of AI. So what's happening is these marketplace and scale players, such as Costco, Walmart, and Target, are getting bigger. And we have to really watch balancing that against small businesses, innovation. That being said, some categories like beauty have tons of great founder-led brands. But margins in this business can be thin. The exception is beauty and some luxury, given that the cost of goods sold is somewhat low relative to how much they charge.
How much leverage do you think this sector has over the administration? There was an important meeting, and Lisa referenced it earlier on this morning, between some of the biggest retailers in this country, meeting with the president and warning him several weeks ago about what could happen in the coming weeks. Do you think they've played a major role in what we're seeing this morning?
I think they have, because the nature of business and capitalism and how Walmart is so well regarded across managing through these tough times. And also thinking about the U.S. consumer, 90% of the U.S. within 10 miles of a Walmart. So people see egg prices, they see toy prices, they see electronics prices. And Walmart has pharmacies. So I grew up in Natchitoches, Louisiana, going to the Walmart pharmacy. It's a part of the thread of America. So I think it has been important. And Doug McMillon is a great ambassador in terms of understanding short and long term, as well as thinking more broadly about stakeholders and employees in the age of AI.
Managing this inventory story through the last few months must have been phenomenally difficult. Can you share with us what you were hearing from individual companies about how they have navigated the last few months?
So I was on the call with Hong Kong like most nights, and it's been pauses, it's been disruption, it's been high-speed shipping, it's been confusion. It's also been unclear. The price raises were still being determined. We're going to see some interesting stuff come Q4. Late August and October and September, we'll see some incomplete, interesting apparel collections, because basically a lot of retail has reduced orders and was trying to chase. And that may or may not be possible. It just depends.
So Torsten Slok of Apollo, who was on earlier this morning, put out a chart over the weekend that shows that there are lower inventory to sales ratios for retailers today than there were going back to 2019 before the pandemic. Just how close were we to shelves actually being empty?
Well, we'll see emptiness in August, and retailers have been working on this whole journey to get the supply chains a lot faster, but that puts them at risk with these rapid changes too. I think we'll see selective empty shelves. But the consumer is still fragile, and that consumer confidence has been a cautious point. And as people have paid more for food and still feel inflation now, they've been skipping trips on apparel, skipping trips on things they don't necessarily need, and also trying to avoid high ticket. So it's something we're watching, in the seesaw of consumer confidence is key.
You know, there was this image in my head of the ships that weren't coming from China, that were not necessarily on their way, and it takes a while for those ships to get here. You said that there still are shelves that are going to be empty. Are you still seeing the potential for some delay in between when those ships arrive, when the orders are placed for particular retailers?
Well, what's good is, as we get through earnings season, is spring, summer goods are in pretty good shape, and they've arrived. What's problematic is back to school. So there may be some missing classifications. Also, if retailers indeed did order about 20% less, we're starting off a little bit negative for back to school. But that was the right choice you or I would have made to protect margins in this unknown scenario. But right now, maybe we're going to get different phone calls where, hey, we want those shorts now. What can we do? They're going to be a little bit more expensive, but that's happening probably, this morning.
Everyone's hustling Oliver, it's good to see you. Thank you, sir. Oliver
pleasure.
Chen there of TD Cowen on the latest with the retailers. I understand we've got Mike McKee standing by who can talk about how disrupted the economic data will be over the next several weeks. We've got CPI tomorrow morning. We've got retail sales on Thursday. You'll hear from Chairman Powell as well before we get to the end of the week. I understand Mike McKee can join us right now. Mike, let's talk about how disrupted that economic data will be, not just through the next several weeks, but maybe even the next several months.
Well, it's going to be disruptive because we still have tariffs in place. We still have the 30% on China. And to the extent that interrupts what's going on in terms of commerce between the two countries, that will be something to watch. In terms of inflation, that will be something to watch. We've got other tariffs that are going to be coming on that the president has announced. And we've also got the 10% universal tariffs around the world. So prices are going to be a little bit higher. They may not be as high as they might have gone, but it's still going to be hard to know exactly the impacts on the overall economy. We can figure that companies will do a lot of ordering in this 90-day period to try to get ahead of whatever might happen at the end of it. But after that, what happens? And do companies still want to hold off on spending a lot of money on investment because they don't know where this is all going to end up? So a lot to watch in the data. Tomorrow, especially with the CPI, isn't going to matter much to the Fed in the short run, but at least we'll get some clues as to where maybe some of the inflation aspects of this are going to start popping up.
Mike, stay close. We'll come back to you in just a moment. Need to talk about the Federal Reserve as well and what we might hear from Chairman Powell this coming Thursday. I imagine he's pretty happy that he didn't say much over the last month.
Well, this is exactly what they can say. Of course, we're in wait-and-see mode because we were waiting to see exactly for this. I will say that Neil Dutta of Renaissance Macro put this out saying he doesn't see why much has changed for the Fed, saying that there had already been a weakness built in and some damage done. So the debate will continue, but there is a question here about how much they can kind of take a victory lap for wait and see.
Major rally in this equity market. We waited and we see a lot lower tariffs this morning. Equity futures up by 3.2% on the S&P 500. In the bond market, yields are higher across the curve, particularly at the front end of the curve. The two-year yield higher by 10 basis points, going into a week full of economic data. Tomorrow morning, we get US CPI. On Thursday, we get retail sales. But maybe for many of you, the most important economic data point of the week might come from a company and not the economic data. It might be Walmart results this coming Thursday. We'll hear from Chairman Powell, too. We'll get Mike McKee's thoughts in just a moment. And we'll catch up with Seth Carpenter of Morgan Stanley and Earl Davis of BMO with CPI data just around the corner and their reaction to a big announcement over the weekend. Waking up this morning to much lower tariffs on both the US and China, a 90-day truce between the two biggest economies on the planet and ending an effective trade embargo. From New York City this morning, good morning. This is Bloomberg. Bit of cheer for Academy this morning. Was it all just a bad dream? It was real. Equity futures on the S&P 500 positive by 3% off the back of a trade truce between the US and China. Big rally elsewhere on the Nasdaq. On the Russell. The Russell 2000 futures up by 4.6%. With some morning movers, let's cross over to Danny Berger. Hey, Danny.
Hey, John. You can see it on that board there. Some real market leadership coming not just from small caps, but tech. Look at what some of these Mag 7 names are doing. Some real outperformance. Amazon and Tesla seem to be leading the pack, up at least 8.4% for the two of them. Apple also higher in the pre-market session, up 6.5%. Some also journal reporting that they're planning on raising iPhone prices, but trying not to seem like it's tied to tariffs. Elsewhere, to the downside, it is healthcare, a double whammy. For one, it is a safety sector, so why would you buy healthcare when all risk is rallying? But two, Trump planning on an executive order, putting this out on Truth Social over the weekend, saying that he wants to lower drug prices from somewhere between 30 and 80%, matching the lowest rate of the lowest country out there. So you can see across the board, Pfizer, Lilly, Gilead all dropping by around 3 or 2%. Finally, John, you mentioned before the break that we're going to get Walmart earnings this week. It is a solid day for the retailers and consumer-oriented companies, for both a recession risk being priced out and perhaps easing of supply chains, Nike being one of them, up 6.5%. Ryan Peterson of Flexport saying the next 90 days we're going to see a shipping boom. these retailers may be trying to pull forward and get ahead of what changes might come after those 90 days, John.
It's going to be busy, that's for sure. Danny, thanks for this morning. Busy week for economic data. Earnings too. Walmart on Thursday alongside retail sales. And you'll hear from Chairman Powell as well. Mike McKee's back with us. Mike McKee, for the Fed speak, I imagine it stays pretty consistent. Does it change after the weekend?
Yeah. The Fed is going to be watching the data like everyone else and watching to see what the results of all this are. We don't know yet. I mean, this is sort of an interim step in terms of this long process of tariffs playing out. But we do have price week in effect this week with CPI tomorrow. PPI coming up on Thursday, along with retail sales, import prices on Friday. So by the end of the week, we'll have a pretty good idea of what PCE will be. Interesting thing here is probably that Thursday's retail sales report and Walmart report are going to be the big issues of the week, because the question is, did consumers continue spending? And we'll get some headlines, of course, from CPI. Wall Street focused on that. These are some of the areas to watch, because these are some of the areas where we might see prices rise because of the tariffs that had been in place and the threat of tariffs that had been in place. You can see what happened in March. The Fed put out a study on Friday, you may have missed this with all the other news going on, saying that they are looking at ways to track inflation brought on by tariffs, and they already see it in some data. So we'll see how this all works out over the next couple of days as we get all these price numbers.
And Mike, clearly it makes a difference that we come down from 145 to 30. But do you think the Federal Reserve is still focused on the ramp up, not the move down, the move from where we were at the start of the year to where we are now?
They can only deal with what we have, and so they will be looking for any inflation effects, and whether it's the 145 or the 30% or wherever we end up. It's going to be a question not just of how fast the numbers go up, but how far they go up, whether it's a one-time thing or not. But it does give them more breathing space not to do anything, is kind of the conclusion coming out of this. I do want to mention Jay Powell on Thursday. If he wants to talk about it, he can. But this is a Fed Listens event to talk about the framework agreement, the review that they're doing. So I wouldn't expect much from him.
He's got the option to ignore it if he wants. Mike McKee, thank you, sir. The latest from Mike McKee on the Federal Reserve and the economic data. Seth Carpenter of Morgan Stanley joins us around the table. Seth, good morning to you, sir.
Hey, Jonathan.
Quick
how are you?
thought exercise. I'm okay. If the Federal Reserve knew what they knew this morning, would they have changed the statement in the way they did last Wednesday?
I don't think they would have. Look, where are we? Right now, we're going to get a CPI report tomorrow, and it's going to be pre-tariff for the most part, maybe a little bit in autos, but essentially that's also going to be pre-tariff. And they're going to want to look at that to see, are they learning anything on inflation? And so what they said at the last meeting was there's uncertainty. There's uncertainty on the inflation side. There's uncertainty on the growth side. Does the news that we've got in the past 24 hours change that? I'm not really convinced that it makes a massive difference, because the announcement was that tariffs will come down from the peak, still be above where they were at the beginning of the year. And I think we have seen a few times in the past few weeks, times where one announcement gets made and then it's reversed 24 hours, 48 hours later. I'll believe this is real when I've seen it in place for a while and it actually starts to affect the trade flows.
Your assessment of the risk, though, for inflation for growth, are they still tilted to the downside for growth and tilted to the upside for inflation? Is that how you see the risk?
Unquestionably. So we do still, no matter how you slice it, have higher tariffs this year than we had coming into the year. And so that's got to push up inflation. Now, in 2017, 2018, 2019, I said, much like what you've heard from Powell, the inflation side of things from tariffs likely to be temporary. Might even use the word transitory if it hadn't become taboo. That's still very likely to be the case. However, now versus then, we have lived through years of higher inflation, and it's not at all clear where businesses and households' minds are for how inflation dynamics get going. So I think there is still upside risk to inflation. The downside, businesses that plan, businesses that are going to undertake investment spending, businesses that are going to make hiring plans would like to have some certainty, and we have none of that. And again, just because there was a statement that there was a plan to make a plan to have a deal does not take away that uncertainty. So again, the risk to the downside in growth, I think, is real and present danger.
A number of guests have come on the show this morning and said that at the very least, it does make recession look more like a remote possibility rather than a 50-50 type of possibility. Do you agree with that?
So I think it probably has to lower the probability. Remote seems a little bit optimistic. Again, how much of an effect does the overall uncertainty affect business spending? I think I know pretty clearly what the direction is. I don't think I have any conviction I know exactly what the magnitude is. And so to be able to say it's going to slow things down a little bit, but not so much to tip us over, that's our baseline view. Don't get me wrong. I just don't know how you have conviction there to call it remote.
It sort of raises the point of the Fed's reaction function. It's something that's interesting when you look at Fed funds futures this morning. You're only seeing 2 rate cuts getting priced into the market from 4 last week. It highlights this idea that without some sort of rapid deterioration akin to a recession, you're not going to see that rapid response from the Fed that could be 125 basis points of rate cuts like Citi's Andrew Hollenhorst has called for. How much do you take signal versus noise from the market's reaction? I mean, would you agree with the current assessment?
I would not. In fact, we've been far, far, far out of alignment with the market pricing has been. We have said even before this announcement about the possible de-escalation on tariffs, we had said the market calling for 3 or maybe 4 rate cuts this year was overdone. We don't have any cuts in our forecast for this year. The market's coming towards us, which is always a comfortable place to be. But the Fed's got a really tricky challenge. Tariffs, even if it's at a lower level of tariffs, they will push up inflation, and that probably happens faster than any hit to growth that we're going to see in the hard data, which is where the Fed is really living. And so what does that mean? They have to watch things come in, and they can't take anything for granted.
We often cite you and Mike Gapen, because you are at zero cuts for 2025.
And because we're both tall and good looking.
Of course, that too. That's why I do it. Andrew Hollenhorst at Citi, another tall and good looking gentleman, is at 125 basis points of cuts for 2025. And we've said repeatedly, you can drive a truck through those estimates. They believe the labour market weakens in the coming months. What gives you the confidence that it won't?
I think a few things. One, the U.S. economy tends not to shift quite so dramatically. We do have a big slowdown in our forecast for the next several months. So I think that in that regard, it's likely to happen. But the first thing you need to see is businesses pull way back on the hiring, and then you're likely to see businesses start the firing process. And you need both of those to happen first before the Fed can go into a full-fledged cutting cycle. Very difficult to see they get there to get that amount of cutting this year.
Seth, it's good to see you, sir.
Thanks
for dropping by. Thank you. The tall and good-looking Seth Carpenter there of Morgan Stanley. Let's get over to Earl Davis of BMO, another tall and good-looking gentleman, just before people start getting jealous. Earl, welcome to the programme. In the bond market, we're seeing yields reprice higher, 2-year, 10-year, 30-year. Earl, do you see it as a good place to get back into the bond market to buy at these levels across the curve?
Very close. I believe last time I was on the program, we said 425 to 450 was a buying level. We actually stopped at 450. That doesn't happen often. And then went back down to 410. So we were fortunate to take advantage of that and go underweight duration, which we are now. So our strategy now is to cover the underweight at 450, but we believe it could go up to 475. We see that as a strong buying level. So, and the reason why we see that as a strong buying level, the market only has the ability to focus on one thing at a time. And right now it's not growth. We think the growth focus or lack thereof will be the summer focus. But right now there's a bit of euphoria in the market.
As you know, well, this morning off the back of this tariff announcement, a lot of people have come on the programme and said we've removed some of the growth risk. Open question remains as to whether we've removed some of the inflation risk. Where do you stand on that?
Let's go back on the growth risk. I don't think we've removed some of the growth risk. I think the growth risk is definitely still there to the same extent. The magnitude of the growth risk has been reduced. So let's be clear there. Inflation's the same. You know, the numbers, like, we're still at 3%. 10-year bond yields are at 4.5 to 5. We're at 2.5 inflation. Real rates look real attractive. The only reason we're not buying now, and we think it could go to 475 over anything, is supply. There's 3 things that drive the market: growth, inflation, supply. We believe supply is what will drive yields to new highs, but that's not going to be a story until the fourth quarter of this year. So that's why we don't mind buying this back up. We think the market's getting ahead of itself, but justifiably so.
I'm glad you went there, Earl. There's this question about the budget discussions, which are ongoing, and we got the reconciliation budget on Friday. There's a question about inflation, and then there's this question of who's going to buy all of this supply and whether that has structurally changed since April 2nd. What's your view on that? How much have you seen a real shift, pullback from investors in your Canada that may not necessarily want to buy U.S. dollar-denominated assets?
Yeah, I don't think the economic buyers have changed. They just buy at a different level. And what is that level? We think ultimately U.S. 10-year yields, if you get to 5%, is very, very attractive. And how do we justify that? We justify that quantitatively. What we look at is if you buy at 5% and get how much interest rate hikes are you protected for? You're basically protected for 100 basis points of hikes from 5%. So we think that's very attractive. We think you'll get real money buying at that point in time. And we believe also by that point in time, growth will be a concern as well, too.
This raises this question. You said that you're still tactically overweight U.S. assets, even with some of your concerns about yields going higher and, frankly, growth concerns, although that might actually help the case. Why is it that you're not leaning into what we're seeing elsewhere, which is buy everywhere else? I mean, does it make a difference what we've seen overnight, or is this just something structurally that you think the U.S. is going to be a higher income space than the rest of the world for a prolonged period of time?
Yeah, I smile because I've been in the market for 30 years, and it always reminds me of the Keystone Cops. The market always has a tendency to run one way and then try to turn and fall over itself. It's while they're falling over themselves that where we look at value and try to pick up value. So now let me answer your question more directly. We like U.S. assets still and risk assets in general for two reasons. One is there's global easing going on. Even though the U.S. is not easing, there's global easing going on. So people are trying to offset the tariffs globally, which has an impact on the U.S. as well. And there's significant amount of money on the sidelines that is not going to be making as much yield as you could be in risk assets. And we believe that will start piling into risk assets as well. Having said that, similar to the way we're looking at duration and go against the market, we are coming close to levels where we'll start reducing our risk asset exposure, still being overweight, but reducing because we do think there will be growth concerns around July-ish, August, as those sort of tariff numbers, economic numbers start coming in.
Just, Earl, build on that, please. I mean, which assets are you thinking of in particular? Is it in the credit space, the riskier credit, where you think things are getting a bit lofty, given what you see going forward?
Yeah, actually, in April, and don't get me wrong, there were some gray hairs that happened there. We allocated to high yield. We bought select names in high yield. And the reason why was we went right up the capital or very safe high yield, call it double B is what we were looking at because we believe there's protection there. You're being rewarded 9-10% all-in yield, very attractive now, great risk reward. And there was no signs of a recession. The economic numbers were still good. Yes, all the surveys were bad, but the economic underlying numbers were still good. We see it in employment. We see it in growth now. There'll be a slowdown, but there's so much cash on the sideline. The deregulation, people forgot about that. And one of the Trump era, or President Trump's era things is deregulation, very stimulative. So a lot of reasons to be selectively choosing credit. We don't foresee a recession in 2025. We haven't. We've always been very consistent in that. 2026, we'll analyze at the end of this year. But right now, things look good. And you know what? Up to today, you were being rewarded for going more and more into risk assets.
Earl, as you say, up until today, what do you do after today?
It's exactly as I said. There's no catalyst for us to go higher for risk assets to sell off right now. No catalyst. We believe that catalyst will be a July-August catalyst. But the risk reward. So we are reducing our exposure very slightly on any sort of exuberance. We reduce. And I'll tell you the reason why. I don't know if you've been into the doctor, you get hit on the knee with the rubber hammer and the leg goes up. Our question is, how long does it stay up for? Is it just a reflex? Our feeling now it's going to come back down, which is why we're reducing risk exposure to risk assets, but staying overweight.
Interesting. Earl, thank you, sir. Appreciate the analogy. Earl Davis there of BMO Global Asset Management. Earl, thank you. Thinking some of the growth risks might return later on this summer. At the moment, the 10-year yield is high by 7 basis points, 2 years up by 10. Earl thinks we're getting closer and closer to that buy zone in the bond market. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. President Trump heads to the Middle East this week in the first state visit of his second term. Trump is set to land in Saudi Arabia tomorrow, then visit Qatar and the United Arab Emirates before the end of the week. He's looking to encourage the wealthy Gulf nations to invest in the U.S. Meanwhile, Japanese Prime Minister Shigeru Ishiba says the country will not accept a trade agreement with the U.S. without an accord on autos. Meanwhile, Japan's top trade negotiator adding the country will continue to look for a reprieve from all U.S. tariff measures and hopes to reach an agreement in June. And in sports, the Indiana Pacers are one win away from the Eastern Conference Finals after blowing out Cleveland in Game 4. Elsewhere, the Thunder evened up their series against Denver. And tonight, the Knicks look to pull ahead against Boston after losing Game 3 at home. Meanwhile, the Timberwolves take on the Warriors in San Francisco, up 2-1. That's your Bloomberg Brief. John?
Yohara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the week ahead, and we'll head down to Washington, D.C. to get you an update from Bloomberg's Tyler Kendall. From New York, this is Bloomberg. Live from New York City this morning. Good morning to you all as we count you down to the opening bell. Equity futures here up nicely. Positive by 3% on the S&P. On the Nasdaq up by 3.9. On the Russell up by 4.3. Your trading diary for the week ahead. A sneak peek. It looks like this at 9:30 Eastern Time. President Trump holding a news conference, signing an executive order to lower drug prices. Tomorrow we'll get some CPI data, plus Trump heading to Riyadh for the first stop of his Middle East trip. On Thursday, PPI, retail sales, and another round of jobless claims, plus remarks from the Fed Chair Jay Powell, plus Walmart earnings. Thursday's a busy one. Busy morning already. We caught up with the Treasury Secretary, Scott Bessent. He recapped the trade talks with China over the weekend.
This is a pause down to 10%. The April 2nd level for China is 34%. So we will be working to see where their final reciprocal number ends up. I'm not saying that they're going to go up, but it would be implausible that they would go below 10.
From the White House, joining us now is Bloomberg's Tyler Kendall. Tyler, welcome back to the program. Have we got an understanding now of what the next 90 days is going to look like?
Yeah, hey, John. Well, the Treasury Secretary sort of outlined some of the threads that we can be watching for. He told you that the Phase 1 trade deal is going to be a template for the negotiations with China going forward. So we can watch how U.S. ag imports start to factor into the conversation and whether or not the White House really starts to talk about those enforcement mechanisms that are going to be needed in order to hold China accountable to any future purchase agreements. The second part, of course, though, is that he also emphasized to you and Lisa the importance of cracking down on fentanyl. And when you pressed him on exactly what he wants to see from China, he ultimately said that they would like Beijing to really start to crack down on the suppliers when it comes to the ingredients and the chemicals that go into fentanyl shipments, saying that the Treasury is closely tracking how those shipments are making their ways overseas. Now, ultimately, of course, it was pretty remarkable to hear him say that that 10% levy is likely not going to fall lower, that would be implausible. But you probably noticed that he did say that that 10% levy is also what's in place for our other trading partners. And our reporting indicates that going into these negotiations this weekend, China wanted what was described as non-discriminatory treatment. They wanted to be treated like these other trading partners. So perhaps, John, this is part of sort of that softening of rhetoric that we're seeing as this major de-escalation begins.
Tyler, it raises questions about what will happen with their other trading partners. We've had a deal of sorts with the UK, an agreement of sorts with China, and the question we keep returning to is, where are the Europeans? I've heard plenty of headlines on Japan, India, Korea. Where are we on a deal with the Europeans?
Well, at this point, it appears that very little progress has been made when it comes to the EU. And there's a few different mitigating factors here. Of course, they are negotiating as a bloc instead of individual member states, which really does raise some concerns when it comes to how this administration wants to see non-tariff barriers addressed, such as the VAT or digital services taxes. The other part of this is that the EU also factors into another priority of this White House, perhaps more than other trading partners, and that's when it comes to national security and defense spending. We can't forget that NATO spending and boosting defense spending has also made its way into these trade negotiations as we start to see the rhetoric heighten when it comes to a potential Ukraine-Russia deal. That could also potentially come back into the fold here.
Tyler Kendall with the latest from the White House on a trade front following a 90-day truce between the United States and China, unlocking a major rally in this equity market. Going into the opening bell, Lisa, in about 37 minutes' time. We're looking ahead to data, earnings from Walmart, and you'll hear from Chairman Powell later this week.
Yeah, which is going to be the most important. I'm still thinking about what Earl Davis said about that rubber hammer on your knee. And when your knee goes up, your leg goes up, and it's sort of, how long is it going to stay there? Is this just sort of a reflexive response? Or
What
is
was the
this
hammer, the
something
tariffs?
Yeah.
Is that what he's getting at?
I think that the hammer is the headlines that we keep getting.
The headlines?
The headlines.
On the tariffs?
On the tariffs, and they
Okay.
cause the leg to move. And then the question is, do they just come back down? Is this going to be another whipsaw of the whack-a-mole
Got it.
headline hammer that we keep seeing? So here's the question going forward. What sticks? And I think that you've done a great job highlighting how it is going to be ultimately the question about how inflationary the tariffs that are in place right now are going to be and how you feature that into the conversation. Does Fed Chair Jay Powell reflect that in his conversation? Or did he say, did you guys not hear me say wait and see? Because I said it about 25 times. I'll say it again right here.
Chairman Powell set himself up for a pass this coming Thursday because Chairman Powell is already going to do an address on the framework update for the Federal Reserve. So if he doesn't want to talk about this, he's got the option not to talk about it. What we've got to figure out is whether this economic data in the coming weeks is useful or not, and whether it's useful for what.
This is a real tricky thing, considering the fact that a lot of people are saying that it's incredibly messy. Think about the bring forward types of purchases with Lori Calvasina buying an iPad for her toddlers, although they said that there wasn't any bring forward there. There is this question about how quickly you will see the inflationary pressure. Michael McKee talking about how a Fed's indicator stripping out tariff-related increases is showing some impact. How do you distill that, given the fact that gas prices are down at the same time that you're seeing increases in prices in, say, toys?
It's going to be a messy few weeks and months potentially for the economic data, maybe a messy year. Coming up tomorrow morning, Peter Chair of Academy Securities, the former Biden economic advisor Mike Powell will speak to Emily Rowland of John Hancock and David Kelly of JPMorgan Asset Management as we count you down to the opening bell with equities very close to session highs. The S&P 500 up by 3%. Live from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Italian Open update for Bloomberg TV and radio from Tennis Channel. World number one Aryna Sabalenka punched her ticket into the round of 16 with a comeback win over former major champ Sofia Kenin. After taking the titles in Miami and Madrid, the 27-year-old has now won 21 out of her last 23 matches. And don't forget, you can watch all the action live daily on Tennis Channel.